Welcome to the 2021 Annual Business Luncheon of the Capital Market Solicitors Association, themed Technological-Driven Products in the Capital Market, Prospects and Challenges. Due to COVID restrictions, just like last year, we're holding this year's conference virtually, and we are glad to everyone who has logged in. My name is Vincent Iweze, the Secretary of the CMSA, and I'll be your compere for today. And without further ado, let me invite Mr. Benjamin Obidiegu, partner with Hemon Barristers and Solicitors, and the Chairman of the CMSA. Mr. Chairman.
Good morning, ladies and gentlemen. It is indeed my pleasure to give these short opening remarks for our 2021 Annual Business Luncheon. I'll start by recognizing our keynote speaker and the Executive Director, Operations of Securities and Exchange Commission, Mr. Dayo Obison. Also, our special guest and Chairman of Coronation Capital, Mr. Ike Imogoje. The Chairman of our Board of Trustees, Senator Odujiri. Learned senior advocates, distinguished members of the Capital Market Solicitors Association, our various guests and attendees, members of the press, ladies and gentlemen, it gives me great pleasure to formally welcome you to the 2021 Annual Business Luncheon, themed Technology-Driven Products in the Capital Market, Prospects and Challenges. Like the MC had mentioned, for the second consecutive year, we are having the event virtually. Of course, we know it's because of the circumstances we found ourselves. For those of you that are signing in for the first time, attending this for the first time, let me give you a little bit of a background. The Capital Market Solicitors is an association of commercial law firms that deal in capital market transactions and are registered with the Securities and Exchange Commission. The association was formally registered in 2001 under Part C of the Companies and Other Matters Act. So essentially, CMSA is 20 years this year. And our founding chairman is Dr. Anthony Digbe, SN. Annual Business Luncheon is our flagship event. And what do we do at Annual Business Luncheon? It's an opportunity that we use to take up burning issues in the capital market, bring them to fore, have conversations around them, and come up with suggestions on the way and manner such issues will help to deepen the market and indeed expand our knowledge too of goings on in the market. 2 years ago, for instance, we talked about how to access funds from the capital market to develop the housing sector. Last year, it was about accessing funds from the capital market too to develop the health sector. This year, we are talking about technology-driven products. The planning committee have put together a very strong team of experts and practitioners that will deal with this topic and subtopics. So I'm sure that we're all going to have a good time today. Before I conclude, may I say a very big thank you to the Executive Director of SEC, Mr. Dayo Bison, for his time. And as always, we pledge that the association will continue to work with SEC towards moving the capital market forward. I also thank in a special way Mr. Aigboje Akimokode. I know how difficult it was for the planning committee members to be able to get him to speak to us because of his very busy engagements. Mr. Akimokode, we're very grateful. I also want to thank members of the planning committee, led by Mr. Ayodeji Oyetunde, partner in the firm of Alukan Bode, for the wonderful work they've done trying to put this event together. Mr. Oyetunde, we are indeed grateful. Not forgetting our sponsors, without whom we wouldn't have been able to put the event together. Again, to our sponsors, we are indeed very grateful. I have no doubt that we are going to have a great time today, and I urge you to sit down, relax, and listen to our speakers. Thank you very much. May God bless CMSA. May God bless Nigeria. Thank you.
Thank you, Chairman, for your remarks, which has definitely helped us in setting the stage for today's discourse. Now, we're indeed honored to have in our midst Mr. Dayo Obisa. Mr. Obisa is currently the Executive Commissioner in charge of operations at the Securities and Exchange Commission, where he oversees investment and services, market infrastructure surveillance, and regulation of innovation, among other key transactional matters. Thus, it gives me great pleasure to welcome Mr. Obisa, who will be delivering the keynote address. Thank you so much, sir.
Okay, the chairman of the Capital Market Solicitors Association, Mr. Benjamin Bideku, and the chairman and members of Board of Trustees, the vice president, Mr. Chike Obiamu, all executive members of the Capital Market Solicitors Association. I must acknowledge Mr. Aigboje Mokwede as well, and all the facilitators and participants, ladies and gentlemen. Firstly, I thank you for inviting me to your virtual annual business luncheon. And it is quite humbling that a group of erudite capital market solicitors have chosen the regulators to set the tone of the conversations which will occur here today. Firstly, and rightly so, I would like to commend the leadership of the CMSA for the thought leadership and active participation with the policy initiatives of the Commission. It might be safe to say, as we mark the 1 year in office of this current management come next month, that the Capital Market Solicitors Association has been, and indeed so, one of the most engaging trade groups in the capital market. And if this was a physical meeting, this is the part I would have encouraged you to clap for yourselves based on the level of engagement we have had with you at the Commission. I'm also aware that the annual business luncheon of the Capital Market Solicitors Association has over the years served as an important forum for dialogue on brilliant topics in the Nigerian capital market. And for this, I again commend the CMSA. I would like to start off with a quote from the ProShare Online Trading Report from 2020, which noted, and rightly so, that fintech companies are putting pressure on the brick and mortar paradigms of classical trading platforms and raising the performance bar for younger investors, insisting on a different consumer journey from their forebears. Indeed, the new user of financial products is fixated with speed, governance, responsiveness, and accuracy. There is a clear appetite for technology-enabled capital market products and services. And this is evident in the level of acceptance by users across all age groups, with a high concentration among the youth population. Perhaps one benefit derived from the pandemic has been the consequential upsurge in the adoption and leverage on technology in the capital markets. The last 1 year has confirmed the ability to host trading platforms remotely and transact without physical contact. In March 2020, the Commission requested for all CMOs to forward their business continuity plans and highlights how they intend continuing operations given the advent of the pandemic and the related shutdowns. This highlighted the need for businesses to adopt technology where they didn't have one and gave a good opportunity for businesses, CMOs, capital market operators that is, to test the efficacy of the ones they have put in place. As an example, the NGX, formerly the Nigerian Stock Exchange, activated a business continuity plan, transitioned to remote trading, and continues to operate remotely till date. Despite providing trading facilities remotely, the market rallied to an all-time high of over 20 trillion in December 2020, ultimately outperforming the global markets and closing out the year with an approximate 50% increase in market capitalization. Over the last year also, we have witnessed an increase in the adoption of technology platforms for accessing capital market products and executing capital market transactions. Our engagement with some of the online investment platform operators indicates that over 450,000 users have been onboarded over the last 18 months. Most brokerage and asset management firms have provided tech-enabled outlets for interfacing and onboarding clients, embedding artificial intelligence and robo-advisory in some cases for portfolio modeling and advisory services. The technology trend has obviously had a positive impact on the current state of the capital markets, with prospects for further impacting on its depth and development. For the regulator, this trend has spurred the introduction of regulations on digital sub-brokers, robo-advisory, and other rules, and informed the imminent rollout of our regulatory incubation program, which we target to commence in the coming quarter. The prospects of leveraging on technology in the capital markets are therefore not far-fetched and easily identifiable from the examples which currently abound within the permissible boundaries of regulation. For the market players, the tech-enabled capital market products have the potential to reduce the costs and inefficiency, while improving competitiveness, facilitating speed of service, significantly enhancing the delivery of service to clients, and ultimately improving earnings. There have been some immediate benefits of tech-enabled capital market products and services. As at April 2021, for instance, the CSCS reported that post-trade activities revealed renewed interest and participation of domestic investors, currently contributing about 75% of post-trade activities. This can be linked to the ease of access, which technology affords participants and stakeholders in the capital markets. And again, this position is corroborated by the ProShare online trading reports, which identifies that 72.9% of online trades are equity transactions, with 14.2% being mutual fund transactions, which also involves equity. Data and analytics, artificial intelligence, cloud computing, and distributed ledger technology are the major technologies driving innovation in the capital market. These tools have the potential to transform the capital market through the solutions which they aid, while also posing risks which have to be mitigated. We have witnessed the adoption of data and analytics, as well as artificial intelligence in various capital market products, and our anticipating the adoption in the offering of products, such as the issuance of debt securities from end to end in a manner which securely records all transactions of the chain. This has the potential to simplify the process of capital raising, as well as trading of securities. While in other climes, the potential for technology disruption in the capital market is significantly lower than in banking and insurance, given the high barriers of entry. The reverse is the case in Nigeria, where firms appear to plug and play, with not a lot of cognizance for regulation. And this is where we expect the increased activity and participation, collaboration and cooperation of the CMSA and lawyers in the capital market. For regulators, each benefit triggers a potential risk and challenge for regulation. There are obvious challenges with the adoption of technology, chief of which is the proliferation of unregistered digital investment or trading platforms, whether facilitating access to trading in securities listed in foreign or local markets, or pooling funds in a manner akin to a collective investment scheme without registration. The adoption of technology therefore appears to create bloodlines on when regulation kicks in and to whom it should apply. The regulator is faced daily with the treatment of technology platforms, providing solutions for capital market operators and how to effectively regard and operate with these firms. We are forced to consider how outsourced actions such as KYC, which constitutes a regulatory requirement, can be performed by platforms hosted by equities which are not subject to regulation. This, of course, raises questions around data protection. We recognize that technologies such as artificial intelligence offer potentials for good achievements, but they also pose risk for unintended negative consequences. AI's predictions and decisions are probabilistic, meaning it gives the best answer measured through confidence and precision levels. And even in jurisdictions with a regulatory framework on the deployment of AI, the processing speed and decision-making capabilities of AI are quickly outpacing the monitoring and validation tools available. As a commission, we support innovation, which protects market integrity and ensures the safety of investors' funds, contributes to market depth, and provides solutions to existing problems. We acknowledge that emerging technologies such as cognitive computing, machine learning, artificial intelligence, and distributed ledger technologies can be used to supplement both fintech new entrants and traditional incumbents, and carry the potential to significantly impact the capital market. It is important to stress at this point that being a regulator or introducing regulatory policies may not be as popular at all times. I therefore crave the confidence of your esteemed members as the Capital Market Solicitors Association in our ability to develop and deliver well thought out policies in response to clearly considered risks and identified prospects. As your clients turn to you for guidance, we urge and trust that we can count on our registered solicitors to promote compliance with existing regulations and contribute to the development of new ones to accommodate emerging trends. The CMSA are connectors between the regulator and the market in ensuring compliance with regulations. The relationship is a symbiotic one, which the CMSA stands to significantly benefit from, given that most capital market transactions require the input, opinion of a solicitor, even as we anticipate the launch of exchange-traded derivatives, which are fueled by contracts. I am of the view that the CMSA, more than any other trade group in the capital market, should, and rightly be so, very much vested in the growth of the capital market, and I would like to once again commend your efforts in this regard. More than ever before, the Securities and Exchange Commission is on a collaborative path, engaging stakeholders without shirking our responsibility of protecting investors and ensuring market integrity. We encourage the continued engagement by the CMSA and all solicitors and call for your renewed support in ensuring compliance with regulations which are made with the objectives of managing risk, protecting investors, and ensuring market integrity. That said, we all agree that the evolution to technology-enabled capital market products is here to stay. And I'm certain that the various discussants at this business luncheon today will balance the prospects and challenges of adopting technology in the capital market. More importantly, it is hoped that the discussions here will explore how to drive and encourage the adoption of technology without compromising investor protection, and I trust we can count on the solicitors in this quest. Finally, I thank you all for your kind attention and for the warm invitation to me and the Securities and Exchange Commission, and I wish you fruitful deliberations. Thank you very much.
Thank you, Mr. Obiso. That was indeed very enlightening. And like they say, we all have heard it directly from the proverbial horse's mouth. Thank you again for that, sir. And there's no better way to proceed to our next speaker, who indeed needs no introduction as his reputation precedes him. He's an investor, a banker, a philanthropist, someone with a track record in major achievements, both for profit and for non-profit. He's the co-founder of the Tengen Family Office, former chief CEO of Access Bank, and now the chairman of Coronation Capital. It gives me great pleasure to introduce our special guest, Mr. Aigboje Imokhide. Thank you, sir, for being here with us today.
So I listened to the opening remarks by our regulators, the SEC Executive Commissioner. I really enjoyed them. Let me also congratulate the CMSA for another annual business luncheon. And the partners from Aluko and Yobode who ensured that I provide remarks during this opening session. Well, my name is Aigboje Imokhide. I am a lawyer as well as everybody else on this call and at this luncheon. I also have operated in the capital markets since around about 1988. So in a sense, you know, I am a vested stakeholder in the affairs of your Association. And I would like to take the next 15 minutes to continue along the lines of talking about technology generally as they pertain to the capital markets, and kind of try and set the tone and context for your deliberations at the two sessions that will follow my remarks. Now, I'm going to take this a bit differently. When I say a bit differently, I'm not going to, following a regulator's view, have something of an intermediary or market operator's view, or user of the market's view. The way I like us to look at things is the way I tend to approach, development generally and life, which is to take a global context and then, juxtapose my reality against that global context. I come from this philosophy in life, which is that Nigerians are some of the smartest human beings in the world. We have a very high national IQ. We are blessed in so many ways. Our people lead in Africa and across the world. And so when I set standards for myself or institutions in Africa within which I operate, and I set standards and expectations for our country, I do so against global best practices and global standards. So let's first talk about what is happening with technology in finance. And if you look at progress over the last 20 years, essentially since the turn of the millennium, technology and innovation has transformed society, global economic sector, society. Look, there was a time when for me to deliver this opening remarks, I would have to be physically where you were. We would actually have to gather physically. And at best, if I wasn't there, maybe record a video and so on. And here we are. Anybody can have their food in front of them, wherever it is in the world they are, any of your members, etc., and contribute fully to this event. And just tells you that life has changed, okay? And I like to tell people that if there is one thing, that has near the force of nature, it is this thing called technology. And when technology moves, it's difficult for anybody to stand in its way. And the financial services sector has also witnessed its fair share of changes due to the impact of technology. The word fintech describes computer programs and other technology that are used to enable financial services, especially banking. And the most important or significant fintech has actually been felt in the areas of payments, personal savings, personal lending, and mobile services, okay? Beyond banking and payments, other aspects of financial services are being transformed by technology. For instance, InsurTech describes a similar phenomenon to fintech, to what is happening in the banking and payments technology area. Although the insurance sector transformation has not quite matched banking and payments. Capital markets has not been left out, but globally, capital markets are also playing some type of catch up, to what has happened in banking and payments, financial technology. But technology has indeed altered capital markets over the last 2 decades. The biggest changes have actually occurred in the market infrastructure space. So when we talk about technology and we talk about the products and the opportunities, you tend to jump, into, what I would call the more retail type of practice, because we are thinking in the banking dimension, the payments dimension. But if you think about electronic exchanges, they're just 20 years old. They're completely new phenomenon. Okay, fine, 30 years, okay? Exchange traded funds, high frequency trading, these have been the biggest disruptions that technology has brought to capital markets as we know it. And these are major. I'm talking about changes that have affected trillions of dollars of transaction volume and and impacted really billions of people across the world. Now, globally, however, the nexus between commercial banking, which globally, okay, does participate, probably through partnership arrangements and other type of structures, or when commercial banks are part of, larger, financial service groups, it has seen the application of the deposit and lending technology I referred to, okay, applied to brokerage accounts. And therefore, it has altered the capital market user experience significantly. So the same things that have happened with respect to the banking account, okay, and how the user or the holder of the banking account, expects to receive a service from a financial service provider has taken place, globally in the capital market context. And essentially, one thing that technology does, or probably the most important pulling force for technology, is the fact that it helps you enhance your relationship with a counterparty. It reduces cost, and it also, in a strange way, facilitates regulatory compliance. Technology makes it easier to comply. So actually, generally, technology actually brings about a better market practice and better market conduct. When you use technology, I can regulate you easier if I understand the technology. Technology has democratized access to capital market products, including the very sophisticated products. So technology it is technology that has brought derivatives such as option trading, commodities and futures trading, and more complex capital market instruments, to the hands, or if you like, the computer, where hundreds of thousands of young people, can bankrupt, a hedge fund, okay, who is trading on the other side, of their positions. Now, there is also this power of crowdfunding, and what crowdfunding points to as a new form of distribution, which we must take complete cognizance of. Technology is going to completely disrupt our understanding of how you make bookmaking, and how you distribute products that end up in the hands of the individual. At the end of the day, when you look at all these large asset managers across the world, the large insurance companies, they are huge players, but at the end of the day, unless they are handling sovereign accounts, okay, their clients are essentially people like you and I, the hundreds of millions or billions of people who manage retirement savings accounts and not, one day, okay, technology is going to disintermediate this traditional intermediary, and it's not going to be too long, okay? Now, essentially, what technology will do is that it will match the buy side with the sell side, okay, in a much more cost-effective manner. Now, you may argue and debate issues of education, et cetera, but I'll tell you something which is very simple. The understanding required to operate a mobile phone or a laptop, okay, is probably more sophisticated than the understanding required to understand which stock to buy and which stock to sell. So there was a time when I got into my financial services career, when I'm talking about those days, I mean, 1989, 1988, 1989, when the first mobile, laptops came, which were essentially small mini computers in a small plastic briefcase, okay? And I remember as a lawyer, I was practicing as a corporate lawyer then, what it meant for me to word process and for me to do spreadsheets, etc. How excruciating and time consuming it was. Today, okay, all that stuff that would require me to do, to spend a weekend in the office to hammer out agreements, etc., can be done by your 16-year-old, 17-year-old. They may not have the legal brains, but in terms of the understanding of the mechanics of producing the outcome, okay, they can be done in 30, 40 minutes using their mobile phones, okay? So I'm just saying that when you think about disintermediated finance, and you think about those who potentially will be disintermediated if they don't, embrace technology. My friends, brothers, and colleagues at the bar, it actually also includes the legal profession. If you don't embrace technology, anyway, we'll come there. So, I mean, more recently, new advances in technology such as blockchain have begun to change even the notion of the capital market asset class, okay? And how has this happened? Essentially, what blockchain technology has done is that it provides a new way of looking at risk, okay? A new way of looking at risk and disaggregating the costs associated with risk, okay? So it makes it easier for non-professional investors to get involved in things that traditionally, and including the regulators, would say these things are very, very complex. You can burn your share, which is true, but the ability of the non-professional investor to get in, to understand, is much stronger than it was a few decades ago. So this is also going to disrupt traditional market structures and introduce new intermediaries. And I'll talk about that in the context of Nigeria. Of course, ICOs, which are initial coin offerings, this new and revolutionary asset class, okay, we call them Bitcoin and so on, okay, have brought new dimensions to the capital markets. Increased fraud, not in the sense of fraud in the markets, but bringing fraudulent players who try to mask their transactions and bring such, funding into the markets, et cetera, et cetera. Now, quickly to developments in Nigeria. Now, remember I talked about the global payments, banking and capital markets generally. So think about the banking account, okay, and the brokerage account, okay? Now, Nigeria is today one of the most developed real-time payment markets in the world. We actually rank 6th globally. And 32%, okay, we are growing at a rate of 32.5%, okay, in payments, okay, in real-time payments, okay, through these accounts that I'm referring to, okay? Now, bank accounts have grown from less than 10 million in 2000 to 111 million 20 years after, okay? Now, juxtapose that against the brokerage account. Financial technology is yet to be mainstreamed in capital markets, okay, the way, all right, it has taken place globally, okay? The banking sector payment and deposit account technology has not been leveraged by the capital markets, especially in the area of identity management, okay? And so, as opposed to bank accounts that have grown from less than 10 million in 2000 to 111 million by 2020, capital markets accounts still hover in the region of 5 million. And I think they've been stuck there for about the same period, okay? And this is due to the high level of friction in completing local capital market transactions. Now, again, in terms of the domestic context, exchanges have embraced electronic trading, largely by leveraging off licenses from their international counterparts. The level of adoption of technology in capital formation, market sounding, book building is still relatively low, and in some cases non-existent. Generally, we know that regulation typically lags technology and innovation. So it's not unusual to observe that our regulatory frameworks are just beginning to respond to technology-enabled innovations in the capital market space. The speed of adoption is critical, it's very critical. One must, however, note that, very recently, we issued a digital sub-broker license. So that means that the regulation is moving certainly in the right direction. The regulators that we have now are certainly, seem to be focused and, on the ball, and which is good. And that has to be maintained. To the consternation of our regulators generally, okay, something interesting is that Bitcoin and the interest in this asset class has led to an explosion in retail level activity in our markets, okay? Increasing participation of non-professional investors, but not in our domestic markets, but in the global markets. disrupting local market structures and introducing new intermediaries. And whilst it is normal and usual for the regulator to be concerned when you see disruptive behavior, it then tells you something. It tells you what we can do with the size of the pie if we embrace technology. This is proof of concept that technology can be the big game changer as far as growth of the Nigerian capital markets is concerned. Probably is actually our lowest hanging fruit, given the fact that Nigeria seems to have this comparative advantage when it comes to deploying technology in financial services. I'm saying by global standards. So I need to speak to 4 things that we must get right, okay? There are 4 things we must get right. And if we do, not just the capital markets, but I think Nigeria, will not be the same for it again. And these are not things that are impossible asks. These are things that are well within the capability of our country, our Niger people, you and I, our regulators, to deliver to the economy and of course our 200 million plus citizens. The first is distribution. Now, so this is not disclosing anything, I read online, so I'm sure anybody else could have read online, the fact that a telco, that is a listed telco, seeks to expand its shareholder base by 2 million when it does a public offering. Now, between you and I, okay, I am absolutely confident that we can close that gap from where we are reaching, maybe at best today, in terms of distribution of capital market products on the retail level. At best, if I'm generous, 2 million people, right, in a given year, okay, right? We can reach, okay, minimum, we can go from 2 million to 25 million people a year in 2 years. Look, all we need to do is create a bank to brokerage relationship. That's all we need to do, okay? There are over 10 million pension accounts. All we need to do is create a pension to brokerage account relationship, okay? I can go on and on, right? 2 years, maybe it's actually too long. And think about the size of the pie, okay, when we do that. And related to that, and for that to work, is the customer experience. We have to stop thinking about the capital markets as a place where, for unique reasons, okay, the buyer or seller of securities should undergo pain to do so, okay? This is a traditional global paradigm, but it has been completely put to bed and to rest in Asia, North America, Europe, and so on, okay? Now, this notion that capital markets is this special thing that you do, is a favor, all right, for the man or a woman or a young person to buy and sell shares, technology is what we will use, okay, to dispel it and to disrupt it, okay? So the third thing is capital formation. Once we do the distribution, once we do the customer experience, we are then putting power behind the intermediaries, the issuing houses, the stockbrokers, and other professional intermediaries, okay, to do big, greater things with speed, okay, increasing the velocity of transactions, the number of transactions, the growth of the market, etc., and making Nigeria a viable place for capital formation. Today, most people are beginning to, in raising capital for things that even take place in Nigeria, okay, and actually raising capital even from Nigerians, they actually do a number of these transactions outside Nigeria for things that are taking place within Nigeria, okay? So in any country where capital is formed outside the country for development within the country, okay, you are going to have the type of constrained growth that Nigeria has, has subjected itself to from time to time. Now, I just want you to remember the period 1999 up to 2007, 2008. Banking was a big deal, okay? But think about, banking was the big deal, but think about what happened as a result of the fact that at least 60% of the capital formed during that period was raised in Nigeria. And indeed, it was at that time that we went from less than, I think it was certainly less than 1 million shareholders on record to the situation where we have 5 million shareholders on record. And all of this took place in really 2 years' time, in a space of 2 years. So again, using technology for capital formation, is key. The last thing is the asset classes, okay? And well, yes, you do have crypto assets, all right, as an absolutely new asset class. But I want you to think actually, and this is for the lawyers, think about, okay, the process of democratization being the opportunity to take the traditional asset class, okay, reconfigure it, restructure it into something that is appealing to the retail investor, just in the same way as technology enabled the US markets, okay, right, create the electronic traded fund asset class. Okay, so think about electronic treasury bills. And immediately you understand that once we create that asset class, you have 100 million potential buyers of electronic treasury bills, all the savings account holders, insofar as the yield on that asset, okay, matches or betters the yield on savings accounts, okay, and the utility of that asset in terms of settlement, okay, does not give you an experience that is worse than the savings account, we're up and running, okay? I think I'm kind of, going beyond my time. So I'd like to conclude with this concept of the regulator plus, okay? And I love the direction that the SEC and I believe other regulators are taking as far as growing the pie is concerned. As far as I am concerned, right, there are 2 or 3 phases of regulatory development in any financial market. There is the growth phase, okay? And then there is, okay, so you have this high growth phase, okay, all right? Then you have a policing phase, and then you have a maturization and sophistication phase, okay? We have not even started the growth phase in Nigeria. And in the growth phase, all right, of regulatory practice, the mindset has to be the mindset of the orchestrator. That is the regulatory mindset. The market developer, a regulator plus. That's the only way to think. Otherwise, you will continue to regulate a shrunken or a midget market, okay? And in every market that has developed, okay, you find that the regulator during the growth phase, okay, accepts that the traditional mindset of policing and then moving to the market sophistication and maturization mindset has to be put aside, okay? All right? And this is the time for the regulator as the orchestrator. I think I've given you, in 15 minutes, some food for thought. I think I need to, kind of round up at this point. It's only for me to wish you excellent deliberations, 2 great panels on exciting topics, and all the best. By the way, I think, these 15 minutes earns me some discounts to all you deal teams, that charge me those exorbitant fees. Thank you and God bless.
Very excellent opening remarks, which has set the tone for our discussions today. So we're going straight into discussions, and our first panel is on regulating tech-enabled digital assets. And I would like to welcome Mr. Tony Numa, who will be moderating the first session. Thank you.
Welcome once again to the CMSA Annual Business Luncheon 2021. I won't go over the theme anymore because I think the previous speaker just did a very solid job in terms of setting the tone for this session. For the first panel session, we'll be speaking essentially to regulating tech-enabled business digital assets in Nigeria. And I'll just give a brief pause to allow our speakers, who are also our panelists for this session, who are joining us virtually, give a brief introduction as to their professional experience, as well as their interaction with digital assets and the capital markets space. But before we go on, I'll just introduce myself. My name is Tony Numa. I'm an associate at the law firm of Banwani Godalo, a tier 1 law firm in Nigeria. And my core practice areas include capital markets, mergers and acquisitions, and in this regard, I've advised on bond offerings, equity offerings, listings, and similar transactions. So I'll just pause there and introduce my speakers and our panelists who are joining us virtually. I'll just go around and start with Mrs. Zelda Akindele. Good morning, ma'am. Can you quickly give us a brief summary of your legal practice and experience, and also your involvement with digital assets and the capital market space?
Thank you, Tony. Hello, good morning, everyone at CMSA. Always exciting when we have our annual business luncheon. So my name is Zelda Akindele. I'm a partner at Templars. My practice areas extend to finance and obviously capital markets. I also do some M&A and investments, PE funds work as well. I have almost 20 years experience in the markets now. I have been working on capital market transactions for easily 15, 16 of those almost 20 years, and spent some of my professional career actually in-house at what is now known as United Capital. In those days used to be UBA Global Markets, an issuing house. These days, I am now very much involved in the fintech scene. It's a very exciting place to be, both in terms of capital markets and on the investment side. So I'm really looking forward to an interesting discussion this morning.
I'll just call on Mr. Chimezie Chuta to give us a brief profile of your professional experience, as well as your experience and expertise in the blockchain and digital asset space.
Thank you so much for joining, everyone joining from different parts of the world. It's exciting to be here for a very productive discussion this morning. I'm the founder and coordinator of Blockchain Nigeria User Group, and I'm a very active member of the industry body called Beacon, which is an association, a committee of industry practitioners that have come together to help the growth and development of the blockchain ecosystem. I've been a tech entrepreneur for a while, and tech is my foundation. I'm a developer with over 20 years experience in building web applications. So it's always exciting every time I get the opportunity to talk about technology, innovation, and of course, blockchain and digital financial asset science. I look forward to a very fruitful and productive engagement this morning. Thank you so much.
Thank you very much, sir. I'd like to call on Mr. Efiok Ekbayong from the SEC. Just give us a brief profile of your experience and then your involvement in the digital asset space and the capital markets.
Good morning, participants, and good morning, panelists. I head the asset management services department of the SEC, and well, for over close to 20 years. I've also been involved in supervision of capital market intermediaries. I've also headed investment management department services. My involvement with digital assets has been from 2017. Well, when the commission started the what we call the sandbox at that time, well, it was basically when you have an assessment form, and then subsequently after that, we had engagements. I was a member of a panel engaging fintech companies, and then responsible to also structure them in terms of being able to fit the regulatory profile. So that's the reason why you can have very key to that was Cowrie, I think, Cowrie, the first fund management company, fintech fund management company, which we helped structure them to fit the regulatory profile. And they already having a license with the SEC right now. So that's the extent to which I'm involved in digital assets. Thank you very much.
Thank you very much, sir. Last but not the least, Mr. Tosin Oshibodu, the CEO at Chaka. But first, I'd like to just congratulate Chaka for getting their fintech license as a dealer sub-broker. Congratulations to them. So Mr. Oshibodu, please just give us a brief profile of your professional experience, as well as your involvement in the fintech and digital asset space.
Thank you for having me. So my name is Tosin Oshibodu. I'm CEO and co-founder of Chaka. So my professional experience, I'm an engineer by training, a systems engineer. I'd worked in payments, e-commerce, ad tech, and more in the data engineering side of things. I got into capital markets through, used to build trading bots and still do on an amateurish basis, and got to understand the infrastructure in place. The mission behind Chaka is that over the next decade, people and paper will be less important to the operational functioning of the capital markets, and it'll be more about technology driving this, providing more access, lower costs for more people. We're very passionate about that future for Nigeria, making the capital markets more accessible, and for Africa. And that's a big part of our mission at Chaka. We're also very fortunate and are very pleased that we're the first fintech license from SEC in the digital sub-broker category, and that we are aligned with SEC's mission there as well.
Thank you very much, Tosin. I think what we'll do is just dive right into the session. As you can see, we have a very wide range of expertise across the board on this panel. I'll just first start with Chuta, if you can help us just first break down what blockchain is, what digital assets are, and how we're going to be speaking through that. Because as you can imagine, mindful of the topic for this session, this is a technological concept that a lot of people who are joining us on this platform are still not fully conversant with. So maybe just in simple terms, take us through what blockchain and digital assets are.
All right, thank you so much for that. Blockchain technology is basically part of the progressive steps that the web technology is experiencing, okay, because we'll have different generations of the web, from web 1.0 to 2.0 and now 3.0. Now, what it's basically is they're bringing in a new type of layer of storing data on the internet. Now, traditional internets are known to store data on centralized servers, and centralized servers have a lot of limitations when it comes to managing trust and then controlling the availability of transparency in transactions. And we managed centralized systems for a while, but of course the web needed to upgrade, the web needed to mature, the web needed to incorporate some other things that will make it even much more interesting to use. And so that's where blockchain technology came in. Now, over the past 15 years or thereabout of the web, there has been this problem of double spend. In other words, when you are using carrying out a digital transaction over the web, there's always a tendency that someone could spend a particular asset more than once. So it's called a double spend problem. And there's no other way that problem was solved until 2010, when Satoshi Nakamoto released the Bitcoin white paper. And he defined in his first paragraph that he is proposing a P2P payment system, cash system, to be specific, and it will solve double spend problem. And he proposed a system where there will be a distributed database where users have to have a system or agree on how records can be put on that database. and be distributed and broadcasted to different peer groups. Okay, and that is actually when this technology was birthed. Even though in the white paper there's no mention of blockchain technology, but the understanding of the P2P distribution of the database in such a way that each of the transactions are added in blocks over a certain period of time is actually what came to be known as blockchain, and it's a technology of trust. Now, for cryptocurrencies, you know that I've already mentioned earlier that the problem was solving the double spend problem. So traditional money stored in ledgers, in bank vaults or bank central servers are not reliable when it comes to enabling trustless transfers. So it needed a system where you could use cryptography, which is the technology behind cryptocurrencies, to protect or encrypt the transactions and make it such that when you send it out, you can no longer own it, you can no longer hold it. And that's really a breakthrough. I mean, if I send you a copy of my photograph from my laptop, I still have a copy. But there has never been any technology before then that made it possible for you to move a digital asset from your possession to another entity, and you completely relinquish ownership and control of that asset. And that is the technology behind cryptocurrencies, and it is what is making it unique, is what is making it completely revolutionary, and it's the reason why it is completely disrupting the financial services system. I hope that gives a little bit of background with that.
Thank you so much.
Thank you so much.
I guess for our listeners, that kind of gives a very good summary of what we expect to discuss throughout the course of this panel. In summary, and just chipping in, that essentially means that blockchain is a form of technology that allows a decentralized ledger for storing data, and that's been adopted to a number of other technologies. So I guess one of the more instructive points on this agenda would be the SEC statement that was issued sometime September 2020. I just want to call on Zelda to take us through that statement. I know your firm, Templars, had written an article on this, and I know you were very instrumental to that piece as well. So just to take us through how we see the SEC statement on digital assets, and how we see things moving forward as this market and this space continues to develop.
Sure, thank you very much, Tony. So the SEC statement was actually very welcome, right? You're right, we did talk about it a lot because for us, we saw it as much needed clarity in the market, because if there's anything that this space desperately needs from a regulatory perspective, it's been clarity. Okay, so for us, when the SEC statement was issued, it was hopeful, it was very welcoming. It classified different digital assets. It sort of set out for us, what regulations, what parts of the SEC rules would apply to them. So it gave people in the market a sense of, okay, if I'm going to be doing this, then I definitely fall within the SEC purview, within the SEC ambit, and this is what I need to do in terms of getting licensed. This is how I'm being regulated. So it's a very welcome development. Unfortunately, there were then, other market developments that kind of cast a shadow over that very welcome issuance by SEC. Of course, everyone will know that I'm referring to the CBN letter of February, right? Because like I said, the market felt that the SEC statement on digital assets in September was going to allow us to finally move freely, move ahead with, setting up institutions, getting licensed, transactions, all kinds of things. And then less than 6 months later, about 4 or 5 months later, the CBN kind of, issues a letter, which they didn't say was a prohibition. They told us it was a reminder, right? So CBN comes out and says, we're reminding you, FYI, banks and other financial institutions, you cannot be involved in cryptocurrency transactions. Okay, and that really did sort of cast a cloud because it left the market wondering, well, where does that leave us? Because SEC has kind of identified the different classifications for us. We were just on our way to understanding how we need to get our licenses to operate. And as everybody in this panel knows, it's a very fast moving space. You know, it's not a space that it takes, it's a rapid time to market, the fintech space. So it doesn't take, 1-2 years to bring your project to market or anything. It's the licensing, the regulation part that can actually, and I think Tosin, you can attest to it, that's the part that can actually take some time, So when that CBN letter came out, it kind of left everybody wondering, because prior to the CBN letter, it's correct that CBN did have that policy where banks couldn't transact in digital assets like cryptocurrencies, but the market understanding had been that banks can't hold them for their own account, not that such transactions and trades can't pass through the Nigerian banking system. Now, since then, the SEC, attempted to sort of clarify things for us. There was a press release in response to that. And obviously, the SEC and the CBN are independent regulators, right? So it wasn't necessarily that the CBN letter invalidates the SEC statement, not in any way. It doesn't. They're independent regulators. And I think the SEC press release said as much, okay? But where the market, was struggling a little bit and continues to do so is the fact that there is an obvious overlap between parts of the SEC statement and what the CBN is saying. So if the SEC statement says, we can have digital assets, infrastructure and operators and players, right? But those transactions have to go through the Nigerian banking system, then we have a problem with the CBN, exactly, CBN press release. Now, the last we heard on this, we're fully aware, and I don't know if it's something that Mr. Effiong was going to speak to, but we're all aware that the SEC and the CBN are working together, right, to resolve the unclarity in the market and kind of, pave way forward for us. But it's quite interesting that at the last Monetary Policy Committee meeting in May, the CBN governor hinted at a Nigerian cryptocurrency, a CBN digital asset, so it's a very interesting time in the market. I think the SEC has gone very far in giving us some clarity, because even subsequent to that statement on digital assets, we've had further clarity, we've had further guidance, for example, on online, licensing platforms, etc. So the SEC is doing a lot to clarify that regulatory space. We just need some, I would say, some cohesion between where the SEC is and what the CBN is saying we can and cannot do within the Nigerian banking system.
Very much, ma'am. That's really helpful, and I'm happy that you've set the tone for that discussion. Mindful that we have Mr. Ekpeyong on, and just like Mrs. Akindele mentioned, there's that interplay between the CBN as the apex regulator in terms of legal tender, currency banking in Nigeria, while on the other hand, we have our apex capital markets regulator, the Securities and Exchange Commission, and they're more interested in, the issuance of securities, investor protection. And as we delve further into this, we will see how those two are linked. And that, I think, I'm going to piggyback off that to go to our next question. This is more for Mr. Ekpeyong. How have you seen, and maybe just give us an update on what's the scenario in terms of the CBN and the SEC and the interrelationship, mindful that cryptocurrencies such as Bitcoin, Ethereum, and so on are currency tokens, and that there's that overlap, between the SEC statement and those warnings or cautions that the CBN has given the investing public, not to deal in cryptocurrencies.
Let me start by thanking Zelda so much for speaking to all that the SEC has done in terms of supporting digital assets. Practically and realistically, the two regulatory bodies will have to work together. What you see is the fact that it's clearly separated. The CBN's concern is natural, and you expect that for the fact that in terms of cryptocurrencies, that is also a common thread in different countries. UK, we saw recently what the Chinese super regulator did in terms of stopping the Bitcoin and things like that. Because the issues of currencies is very dicey in terms of the fact that issues of financial stability, the sovereignty of the country, and the pressure is going to put on the currency of the country. So I think that is just the areas central bank is concerned about. And even like what you said, in terms of the fact that countries are looking at developing their own digital currencies, and what the central bank governor said, or the central bank authority said, echoes what is really the reality in the world today. So the issue is the fact that you need to have the country have control in terms of digital currencies. So that's a different ballgame completely, from the aspect of other type of digital assets where you have massive level of opportunities, particularly in the capital market. So you're talking about the issue of the fact of like crowdfunding and the use of crowdfunding, issue of the fact of liberalization of investor, or what they call democratization of investor in terms of securities products. So there are huge opportunities thereby. So it's about having to explore those opportunities, within the capital market because of the issue of efficiencies, cost efficiencies. So you're talking about the fact that let's take, for example, mutual funds in Nigeria. It's been a major tax. Because people don't really know about that. People have been investing directly into the market, which is wrong. And that's why I have a difference from what Mr. Aigbemoku just said. Basically, retail investors should go through mutual funds, and even digital assets like robo-advisory allows that. So robo-advisory will link based on your client profiling, will link you to exchange-traded funds and mutual funds because of the issue of diversification and things like that. So in terms of digital assets, the SEC is very clear about that, and that's why you can see for the fact that we have Chaka registered, we have Carry also registered, and we've been talking to a lot of them, and we've also had to explain to them, and this is where also your role will also going to come in terms of structuring. There's nothing new. It's just about technology. So just bringing about technology and replacing paper and people and stuff like that. So that's just what it's all about. So we are pretty on the same page with the central bank. It's natural that they're going to be concerned in terms of the fact of what the currencies, the risk it bears to the country's sovereignty and financial stability. Thank you.
Thank you very much, sir. Thank you very much for that. Mindful that, I think for the SEC, one of the major issues would be investor protection, as you just mentioned, and ensuring that the participants in this market are very cautious about how they're trading in these assets. I'm happy that yourself and Zelda touched on the CBN's plans to launch a coin, as we've heard in the news, by the end of this year, and how we've seen, in fact, other countries, I think it was El Salvador, adopting cryptocurrency or Bitcoins as legal tender. So I'm just going to, move from that to our panelist, Chimezie, in terms of just giving us a brief outline of what you see from the blockchain perspective as to how the regulators, the market players, and other stakeholders in this space can move forward, and what needs to be done, and any other lessons we can learn from other jurisdictions based on your experience.
All right, thank you once again. The fact that digital financial assets and digital asset technologies that are powered by blockchain technology has come to stay is something that we have to live with, and regulators also know that it's a reality that they have to contend with. Now, we have made some vigorous effort from the industry perspective to collaborate and work with regulators and to find the best way to go about regulation and enabling the environment, because I know that no regulator will definitely want to deliberately stifle the growth of technology through regulation. But one of the key challenges that this particular new asset class poses for regulators is that you cannot use the same tools that you use in regulating the traditional assets to regulate it. The gentleman, my friend from SEC, said that it's basically transferring paper assets to digital assets. It's far, far more than that, sir, because none of the traditional ways of transferring paper to digital assets had the ability for it to explain what we call borderless transfer, which is a key concern for regulators and policymakers. The fact that I could transfer money to some other country without recourse to any standing rules or regulation within the environment where I'm operating is a key concern for policymakers and regulators. And that's why elsewhere they take it very seriously, and they are looking at it and they are figuring how to get involved with it, get the benefit of it, and also allow that innovation to run its full circle. Because the challenge there is that if you don't regulate it properly, then you will run the risk of driving participants underground. Okay, and of course, you know the pain of having a black market for Naira exchange rate, and it's still causing huge pain for the economy today. I mean, the economy bleeds through that open door that the black market operators are using. And we can't allow this new technology to have that same experience. And that's why it calls for concise and deliberate regulatory models that is suitable for these specific kinds of assets. Now, I know that when you use the word cryptocurrencies, the currency part, jostles regulators and policymakers because they think that this is money. But money is basically anything that we agree within ourselves as individuals or community that it's money. It doesn't have to be issued by a central authority. So what we are saying is these are cryptocurrencies. They are not legal tender. Quite all right. So you have to manage them in a way that it will not, drive the participants to go underground. And you have a lot to benefit as regulators and policymakers. I mean, we are looking to grow the economy. We are looking at various options that we can use to attract investment. And this technology in itself has the capacity to revitalize Nigeria's economy, because we are looking at almost a $3 trillion industry, and it's not fair to want to exclude the citizen of your own country from that commonwealth. I mean, I think it's the true commonwealth. That's what blockchain technology provides. It provides true commonwealth where anyone can plug in and have opportunity to participate in that market. Yes, because one of the keynote addressees said when he was making his keynote, because the blockchain technology enables retail investors or retail traders to participate without the regulatory oversight of different agencies that normally control the regular capital market operators, then it becomes too risky for people who are not very knowledgeable in that particular industry. And that's where the concerns are, because a lot of people FOMO in and they lose their money and they don't understand the difference between what they are buying and what they are supposed to buy, and there is this concern. But again, it's education that will solve that problem, not a blanket ban, not a restriction of service. It's education. Awareness has to be raised. I mean, these agencies should be in the forefront of doing what we, the industry professionals, have been doing over the years, educating people, creating awareness, raising the bar between the ecosystem to make people discuss these things in the open. I think that the SEC, Nigeria, Central Bank, and NIDA, all of them, all the regulatory things, they should be in the business of educating the public, not necessarily issuing warning signs from time to time.
Thank you very much for that, Chimeze. Thank you so much. And I think a number of things you touched on from the other concerns, from the regulatory aspect, from the investor protection side, even from the NITSDA data protection angles and whatnot. I think we'll touch on those issues as we go further down in the panel. But just moving to Tosin, how would you say that the current or the existing legal framework is working on a day-to-day operations basis? I know you're largely involved in the fintech space, and you're very involved in how these regulations and statements and laws are affecting your businesses and businesses in your position as well. How do you see those regulations, whether they, in terms of how they suffice for your day-to-day operations of your company?
Yeah, thank you for the question. So right from the start, we've taken regulation very seriously and compliance very seriously. We always knew that what we were doing was something that no one else in the market was doing at the time, at least. And for Shaka, what we do is we're enabling digital investing for individuals, but also for brokers and other market operators. And so, we always structured ourselves in a way as if we were regulated, and in all our conversations legally, that was the posture we had. So we always intended to. So we're very fortunate in these last few months to have been engaged with SEC, to align with them, align with, see a shared mission, especially. I think SEC is very clear on their mission, and it's there in black and white for everyone to see. And for us, our mission of enabling more retail investor participation, of financial inclusion, so making it easier for people with less to get involved in the markets, and of making it easier for global citizens everywhere to be able to access the local markets as well. So for us, that is something that's very, very core to our focus. We have the requisite legal representation. We have officers who are dedicated to ensuring that we stay compliant and that we're proactive about anything that needs to be declared or released or shared. So for us, we've always been structured to be regulated, and I think we've just now doubled down on ensuring that we're going to meet not only the letter but the spirit of SEC's laws. And even besides the legal aspect, because we just like with any kind of deal or partnership, it's one thing to assume you're going to be in court and to start parsing the laws, but then it's also to say where is actually the shared mission that you're headed to, and how do you align to make sure that that's the same place. I think that allows everyone to see the bigger picture as well.
Thank you very much, Tosin. And I think something that Tosin said is really instructive in terms of having ensuring that you have sufficient legal representation whilst and before entering into the markets, particularly for fintechs and other technology-driven companies in this field. So similarly, my firm has been called on to advise on these kind of matters, pre-operational advisory steps. And I'm sure Zelda has also had, one or two reasons to reach out to prospective clients and explain to them how these legal regulations in Nigeria would affect their businesses. Just going back to one of the issues that was touched on, I think, by Mr. Ekpeyong, in terms of the major concerns that you see in this space, particularly in terms of investor protection, which you already mentioned, are there any other key concerns? And this is for the entire panel, and I will go through them one by one, but just to speak to the key concerns that the regulator, say, for example, from a SEC perspective, what are those key concerns that the regulator has?
Well, the key concern the regulator has is, the fact that issues of crypto security, the risk, for example, in terms of the digital space, and just like you're going to have any other regular firm, what risk mitigation do you have in terms of those operating structures and systems and all that. And then, so what securities are you going to put in place to mitigate against cyber risk and things like that? Then there are also issues of anti-money laundering risk, terrorist financing risk, and things like that. So then also too, in terms of like, I like what Tosi said, having to be regulatory, having the regulatory focus, compliance focus from the beginning. So you're going to, just like I said, you're going to have people who are going to come in and also take advantage of tech to exploit people and all that. So the principle of regulation is to ensure an orderly, a transparent, and a fair market. And that's the essence of it all. So it also applies in terms of digital assets. So we need to bring, we don't need to bring around chaos. If you don't have a regulation, you're opening the door for chaos. And that's even why the reason why European Union. So no matter whatever my tech friend says in terms of regulators having to stifle innovation, nobody's stifling innovation. For example, the EU Commission, for example, has a regulatory framework being put in place called Market in Crypto Assets, MiCA. So MiCA is an equivalent of a market in financial instrument derivatives, MiFID. And they're working on all that too, in terms of having to ensure that the right people are there and what are the risks, identify those risks, and that's what regulation is all about. And then ensure that adequate mitigation are in place for the risk. Without any doubt, and all countries will also again exploit the opportunities, like I said earlier on, in terms of what digital assets hold and provide. And that's the way to go. But in doing that also too, we also have to ensure the fact of the integrity of the market is in place, and also ensure the fact that investors' protection. Now, let me say this finally. Now, even if you have, for example, market trading that is based on, let's say, for example, a robo-advisor, and you can have a robo-advisor in place that will have, maybe have a client profiling for maybe HNIs, and the tech will be different. No doubt about that. Even if it's just you're going to say across the board, the profile and investment objectives are the same thing, but technology might be different. And these are things, issues of glitches and all things like that. And we need to look at that and see the fact that sponsors of digital assets have put in place every mitigation against, they've also identified the risk, because it's one thing to be a tech person, but it's a different thing entirely for you to understand the financial market. That's the fact. So you need to know that. So it's not about just being a tech person. You need to understand the market, the way it operates, and that's the reason why, again, I'm going to go back to say, to commend Tosi for what he's doing in terms of speaking to the regulators, speaking to the lawyers like you guys, and having to frame whatever you're doing within the ambit of the law. So it's not all about tech alone. So that's all I can say. Thank you.
Thank you very much, sir. That was very insightful. I'll just hand the topic to Zelda. I know Mr. Ekpayong's already touched on the investor protection angle as well as some others, but what do you see from a legal perspective as the other concerns, and in relation to data protection, the environmental constraints and the protection issues as well, and how those would affect the market from a legal standpoint, mindful that these digital assets and even cryptocurrencies from time to time involve mining, and that will eventually have an environmental impact. So from a sustainability perspective, and in terms of having different investor classes, retailers, different users, I know Nigeria is one of the biggest cryptocurrency countries in terms of participation. How do you see that also from a legal perspective in terms of data protection, privacy, and other legal issues?
I mean, so you're completely right. Nigeria is in the top 5 in terms of volume, highest volume, trading volumes in cryptocurrency and other digital assets. So we're very, very active, right? And there are a number of regulatory concerns. I mean, Mr. Effiok touched on investor protection, which obviously that's the SEC mandate. So it's understandable why he's coming, from that angle, right? And even though the CBN is not with us today, we know that their consideration is, well, they have several, but in this regard, we'd be maintaining financial system integrity, stability, things like that. Then, like you mentioned, we have data concerns. We have the ESG, because data mining is, it saps a lot in terms of energy, and there are a lot of ESG concerns there. So what are the solutions? What's the answer, right, in terms of regulation? The truth is we can't look at this space and say we're going to do a one size fits all. We're going to come out with a nice, neat fintech and digital assets regulation, which is going to cover data protection, ESG, investor confidence, financial system stability. It's simply not possible, right? So instead, what we need to be doing is actually looking at the participants, the activities, right? And looking holistically as the policy objectives. So what would we consider the regulatory policy objectives? We've touched on some of them, it would be things like market trust, right? Market trust, fairness, transparency, because when you look at some of the regulators, like SEC talking about investor protection, they're concerned about what happens when some of these, providers, infrastructure providers, digital asset operators go bust or disappear. What happens when they allow their infrastructure and their assets to be used for criminal activity, funding terrorism, money laundering? Who's watching them with the data mining and the ESG effects, for example, right? So we need to look at those things and what we should be doing, what the regulators should be thinking about. And I think Chuta, I think this is what Mr. Effiak was actually touching on when he was saying that you are substituting paper for digital. I don't think that he meant, and obviously Mr. Effiak, correct me if I'm wrong, I don't think that he actually meant that they're the same and it's a simple substitution. I think what he was trying to say is that in the context of regulation, we have a lot of regulations that address these issues already. What we need to be looking at is where the digital assets, their infrastructure, and the operators will fit in. And I'll give you a couple of examples. Tosin is here. We're all congratulating him and Shaka. They've just been given the first digital sub-broker license. But the reality is we've always had sub-broker licenses under the SEC regulations. They have existed, right? But what the SEC has been able to do is tweak them to meet this new development, to meet the technology, right? And that's kind of what the regulators need to be doing. I'll give you another example. When you talk about the considerations around money laundering, crime, etc. All of these regulations already exist. So what we need to make sure is that the participants and the activities are brought within the scope of the existing AML regulations, the existing CFT regulations, right? So they become regulated entities that have to comply. Okay, then you think about things like investor confidence and trust in the market. So we're concerned that, well, what happens if these guys go bust, if they disappear? So then what we need to be looking at is we already have the ways in which you can capture assets in a bankruptcy, in a liquidation, etc. So how do we bring these operators within those sorts of regulations? And in some jurisdictions, they're already doing that. They're already looking at seizure of digital assets in bankruptcy proceedings, for example. So the truth is we don't have to walk very far in terms of regulation. What we need to do is think wider, think deeper, and more importantly, collaborate with the actual players, right? So, I mean, we're lawyers, we're regulators, we're not necessarily tech guys. So it's fantastic, for example, that we have Chuta and Tosin here talking to CMSA today. We need to be doing more of that because that's going to give us a deeper understanding of how we can use existing existing regulations, right, to manage this space, and also where we need to plug those regulatory gaps. That's really what it comes down to.
Thank you very much, ma'am. And I think one very instructive point that Zelda just raised is around the way that all these concerns, all these issues around how these digital assets would function, how to tax them, how they impact the environmental dynamic, how they would affect data protection. These are all things that must be thought of holistically, and there's not going to be any one size fits all or one document, encapsulating all these issues. Even from a data perspective, the data protection, perspective. For example, our firm, Banwani Godalo, we're licensed data protection, DPCO, data protection compliance organization. And as part of our functions, we undertake data audits for companies like that would be running some of these operations, some of these fintechs. And so it's also key, and I know Tosin mentioned it earlier, it's also key to make sure that all the different facets of the work stream and the value chain for these companies is covered. I'll just go actually to Tosin now. What seems to be, from your day-to-day in the fintech space and the digital asset space, what seems to be the major concern for you, for your company, in terms of the typical operations? I know Zelda has actually touched on one of the very fundamental ones, which is AML, anti-money laundering, anti-terrorism, and how that, you know, requires a vigorous KYC process. But just over to you in terms of what seems to, or what appears to be the biggest concerns for companies like yours.
I think that's a really good question. It actually speaks to the other side of the issue there. So, you know, doing, and at Shaka, we do the KYC checks extensively that are regulatorily required. And that process obviously has been audited and shown to be sufficient. And we then work on making that more efficient for the user. So as an individual, if you wanted to buy Dangote tomorrow or GT Bank or Zenith, and you didn't have a brokerage account, the steps you would have to take to get into the market to still be able to make that buy at the time you wanted to. And the speed at which that would happen may still be too slow for the actor to get in at the time they needed to. This is, I know I know there's a big area of innovation for CSCS, and they're doing a lot there. And same thing for NGX. And I think SEC has already provided even some regulatory frameworks for this. So I think the operational reality of making that as short as possible, while still making the checks as robust as possible. And I think that's where technology is most helpful, right? You can still do a very extensive background check with somebody. And so to what degree can we do that in a very short amount of time and get them into the markets, or reject them from the markets as soon as possible, such that that individual can get into the markets and still take advantage of the opportunity to buy in because they saw an opportunity in GT or in Dangote or in Zenith or in whatever stock that they were looking to buy. I think that will, you know, just let's call it like that's how wide the door is, so that, you know, an impulse can become you're enrolled, because once you're in the markets, any future impulses you have to invest, it's then just an action away. And so there are a lot of people who have been intending to for days, weeks, months, years, and you just need someone to push them over sometimes. Like if it's a cousin or a friend and you're like, buy this thing, try your habits, that level of accountability might be the difference between them getting to the market. But just making that friction point smaller. And I think Mr. Obisona's Kino spoke to this, and so did Mr. Agimokode as well. So what that really I think highlights is that I think a lot of innovation there would drastically increase number of retail investors that participate in the markets. This isn't even conjecture. This has happened in India. In India, when they have an ADVAR, which is, I guess, somewhat similar to BVN, NIN, and supervised identification schemes. And when they adopted that in the capital markets, I think it was rolled out maybe late 2000s, the ADVAR, and it was adopted in 2014, 2015 by the capital markets in India. You just saw brokerage enrollment numbers just go through the roof because, you know, as an individual, you go, you enter your identifier, all the requisite information is provided. Of course, this speaks to the importance of data protection and handling. And then the individuals in there very quickly able to then make a decision. And in the future, they're already enrolled. So I would say that's probably the thing we spend most time thinking about, is how we can, on our end, operationally reduce that barrier, but also, of course, advocate for that with SEC as a regulator. But I think SEC already is very much on this, and NGX and CSCS too. So we're just hoping for, I guess, a faster time to operational improvements there, but we know it's in everybody's agenda.
Thank you very much, Tosin. That's really helpful. Chimezi, I know you're probably itching to give a couple of responses. So I'll just hand over to you to essentially give us a summary of how you see these major concerns from your perspective and your team at the Blockchain Nigeria user group. Like Zelda mentioned, we're the lawyers, we're the regulators, the other stakeholders in the game, but you seem to, companies like yours and Tosin's actually have their skin in the game from a technological perspective as well as operations. So what are the key concerns for you and how you see the existing legal framework affecting that? And please feel free to respond to the earlier comments that were addressed for you. Thank you.
Okay, thank you so much. Fortunately, I was a member of the SEC constituted Virtual Financial Asset Working Group to help draft regulatory framework for the industry. And we worked in that committee for over 6 months to 8 months before the report was finally delivered to SEC and the Capital Market Committee. Now, one of the terms of references that was given to the committee was to look at the current anti-money laundering laws and KYCs that exist and how they can be onboarded to blockchain-based crypto assets based companies that are offering new services and products. And we did make the advice because we didn't make, the committee was not meant to tell SEC to do. What we do was more like suggestive. So we suggested that since there are current AML rules and there are current KYC, know your customer rules that are existing, and the same should be applied. And that exchange operators, who are the key entry point and exit point for digital assets, should maintain strict adherence to these rules, because it's almost impossible for anyone to be able to perpetrate any kind of crime using these exchanges without the exchanges knowing, because they are the primary entry points and the primary exit points. Now, you know that I don't want to indict any institution, but we know that most of the concerns that we have about money laundering and financing, illicit finances, or whether it's terrorism or any kind of thing, is actually done through traditional banks and traditional banking systems. And we know that the buck stops in their court, because if the agencies really want to press on compliance, then they will get to the transaction trails which the banks actually possess. That being said, the industry practitioners, exchange operators in Nigeria, actually operate based on these existing rules, because they do 100% KYC, they do ID verification, and they have some kind of limits that they use to like control, something that is based on the anti-money laundering law. I mean, we can't do a certain amount of transaction in a day. So they have a limit of the transaction. And of course, they also report suspicious transactions to authorities. And they also keep the records in case those things are demanded. So I think by and large, we have gone beyond these as impediments for this industry to move forward. I think what we need now is a strong willpower, a strong motivation on the side of the regulators. You can adopt risks-based approach, because the industry is still evolving, the industry is still growing, and it as though you shuffling your leg is, costing us something, on the economy. Looking at Nigeria's economy, shuffling your leg is costing us something. So if you adopt a risk-based approach, it means that you can always come to update the frameworks that you're using to regulate from time to time. It could be 6 monthly, it could be 1 yearly, it can even be 3 months, because you have to follow the industry's growth with the regulatory requirement that it's needed for you to properly manage that. So we need the regulatory agencies to make bold, to step out and actually start doing what they need to do. We're missing a lot of revenue that should come from licensing. There's a lot of revenue being lost from taxation. There's a lot of revenue being lost by allowing the industry to innovate so that the startups can create more job opportunities for the citizens of the country. So I think that is what we should be expecting from our regulators at this point. Bold steps towards regulation of the industry. Thank you.
Thank you very much, Chimezie. And I think, as we have seen, and I think Mr. Ekpeyong touched on this earlier, and I'm sure his team at the Investment Management Department in the SEC would largely, moving forward, be involving more often involving all the relevant stakeholders. That's the market participants, the regulators, CBN, and all the other players, as they go on to develop more regulations that would govern this sector. I think just before, as we start to round up, it's best that we also, do some retrospection and then looking ahead in terms of how, the capital market and the bond market started, maybe in the early 1400s in Florence, paper ledgers, and, how, the state of Florence then had its citizens becoming investors in the state. And here we are now in 2021, and, cryptocurrency, ICOs, and other investment-based, security-based token offerings have taken place. I'm sure we're aware that sometime in 2019, the World Bank issued its, I think, above $80 million blockchain bonds. So we see the market moving at a very rapid pace, and I think we've kind of captured that all through this panel. But just going back to Zelda, I know we've seen these ICOs in other jurisdictions. Based on the current SEC framework and in terms of how the regulation is today, do you see those ICOs becoming more prevalent in Nigeria? Do you see a lot of market participants then taking up the cudgels to say, we'll start, using this as a means for SMEs to raise capital, for startups to raise funding, and moving forward, how you see that affecting the banking sector as well, or the traditional means of raising capital? Sorry, I know I've just poured a mouthful, but just as we touch on those issues, thank you.
Thanks, Tony. I think there are a couple of points in there, right? And just like Mr. Ike Mokude was talking about earlier, tech in terms of financial services and banking is a massive disruptor. Let's make no mistake, right? So the things that you are talking about, they are in a sense inevitable. So we will certainly see a change in traditional banking. We've already seen it to a large extent, right? But we're going to see more involvement of traditional Nigerian banks, using digital asset infrastructure. So for example, exchanges, settlement and clearing houses, when you look at a lot of global, financial institutions, they've all started using digital asset infrastructure for these things. So the more that Nigerian banks want to participate and be counterparties to those transactions, they also going to have to get on board. But to be fair to the Nigerian banks, they're very aware of this. Nigerian financial institutions, banks and OFIs as well, are acutely aware of the developments in the fintech space and where it's going, and also the opportunities there for them as well. I think one of the things that is potentially not necessarily holding them back, but making things slow down a little bit, of course, is the regulation, which we've talked about. Now, this is kind of linked to the other question that you were asking about ICOs and whether we will see them. Again, it's the same thing. The answer is yes. If you look at the SEC digital asset statements in September of 2020, it recognized ICOs, initial coin offerings. It's not something that the SEC is shying away from. SEC's purview is the offering of securities, so ICOs would fall under that. When you talk about them in the Nigerian market, I think it's worth all of us noting that we have actually had Nigerian companies, right, launch ICOs. They just haven't done them in this jurisdiction. So we've seen them from, Singapore and a couple of other jurisdictions as well. Okay, so why aren't we seeing them in the Nigerian market? Again, it goes back to the regulation. This uncertainty, not having complete clarity, it's what will make participants slightly hesitant, right? But to answer your question, we are inevitably going there. The question of volume is one that we probably can't answer yet. We would expect Nigeria to be a driver in terms of emerging markets for things like ICOs. You look at the tech space in Nigeria and it is rapidly evolving, just rapidly. And because it's evolving in that way, the market, the capital markets, we need to meet that demand. So how are we going to do it? These are some of the ways, some of the things you're talking about. So the answer is yes, we're going to see more digital asset infrastructure, more ICOs, more of this kind of play in the Nigerian markets. The question is just whether the regulation will allow that rapid time to market that we need.
Thank you very much, ma'am. And just piggybacking off that in terms of the speed at which the operators in this space intend to move, Tosin, how do you see, this is where we are today. Where do you see this market for companies like yours 5 years from now? And what do you expect to see or hope to see from your regulators in the medium to long term?
Yeah, so our mission is to, as we mentioned, is to accelerate the digitization of financial markets here, and which will make it more accessible to more people. And we believe very strongly that's going to create some domino effects. So the first is that we do believe that there's going to be a lot more retail and a lot more participants in the market. We think that this accumulation of capital that will come in will then put a lot more of a flywheel to help encourage more promising companies, young as well as more mature, obviously in line with listing requirements here, to see the public markets as more desirable. So we're very bullish on the public markets here becoming more desirable for more and more companies, obviously in line with regulation. And this is not, nobody's working against this trend. Everybody's working towards this trend. Regulators are working towards this trend. And so we see that there's going to be a lot more improved collaboration in hitting some of these kind of goals. I think when you look 10 years into the future as well, something that we expect to see is financial literacy is going to be way higher, both due to efforts that players in the markets have, also due to efforts from regulators and market-wide participants like NGX and CSCS, but then also due to just the rapid dissemination of information. So a lot of people just have a lot more ability to get started learning more. So again, we expect to see more participants because all these trends are pointing to it becoming easier, people becoming more knowledgeable to participate. So in terms of, I guess, where we look at it, we're a bit, I guess, different from some where we don't view regulation in any way like you tick the box or something that's standing in the way of innovation. Financial markets go up and down cyclically, regardless of anything. And on the way up, there's a lot more excitement and nobody wants to slow anything down. But, of course, when there's correction or consolidation, retraction, people usually look to regulators to protect them. So, rather than overdoing it on one end and overdoing it on another, we're always looking and hopeful that both more participants and as well, necessary regulators, especially SEC, of course, in our case, will be able to continue to look at, what actually makes sense long term. So not overreacting to short-term things, either on the regulate less, regulate more, or on the upside or on the downside. So we expect that over time, there's just going to be more clarity across all these new innovations. I think Zelda's point about the speed is so key. So, the more collaboration there is, the quicker everybody can get the same page, the quicker regulation that works for everyone and enables innovation can come to market. I think there's a lot of history if we're looking at it from regulators to show that calls that have been made that enable innovation, it's right there in precedent. So I think it's just when you're in the mix of it, you're obviously hoping for it to come sooner than later. So if you're going to fast forward 5, 7, 10 years, I would expect a lot of these matters we've talked about to be settled. Maybe we're talking about new kinds of matters for the innovation of that time.
Thank you so much for that explanation, Tosin. And I hope as all our participants are on, the relevant stakeholders and the regulators, I will go to Mr. Ekpeyong shortly these are the expectations that I'm assuming a number of big players in the market expect to see as well. Just for Mr. Ekpeyong, I'm sorry to put you on the spot, but what do we expect to see from the regulatory side, from the SEC, in the short to medium term? Just give us 2 minutes and let us know what we should expect to see from your end.
Right. Yeah, we're definitely working very hard in terms of greater, friendlier regulatory framework. I don't need to overflow the fact of the huge opportunities we have in terms of digital enabled assets in Nigeria. And I belong to the Rules Committee. And so we've always had a history of collaboration with Central Bank. We had a collaboration with Central Bank in terms of trying to bring out rules for forex trading. So there is already that relationship with Central Bank in that regard. I will continue to work in that relationship with Central Bank, even in terms of digital assets in Nigeria. And the issue there is having to be nimble and fast about that. And so that's it. We're through with our regulation on our rules. I think, I don't know if it's been released, our rules on robo-advisory, and we worked on that. You also know about the rules on crowdfunding. And so these all point to the fact of the SEC's continued support in terms of bringing our regulatory framework in that regard. And we'll keep on doing that. It's basically what you see in every other jurisdiction, the FSC, UK too. And I've also been working, but all the countries are careful. And regulation is about having to bring out what fits your jurisdiction to the peculiar jurisdiction too, and the opportunities thereby. So I can assure you with the fact that that collaboration with Central Bank has always been, as has always been with the SEC, is going on, and will also continue in terms of digital assets and the way forward. Thank you very much.
Thank you very much, sir. True to facts, we do see those regulations coming out from the SEC. I know recently we did have the SEC rules on crowdfunding, and in fact, firms like ours at Banwa Nigodalo were advising our clients and called on to advise them in connection with, say, for example, the establishment or registration of crowdfunding intermediaries and other players in that space. So I do hear you, sir, and we look forward to seeing the developments that the SEC will continue to make in this space. Just as we round off, just 1 more minute. Chimezie, do you have any final thoughts around how you see the digital asset space moving? Just in a minute, just give us a summary of the key issues that you expect from the regulators, the advisors, and other players in the market just before we close.
All right. Of course, I represent an industry too, and sometimes when I speak more of an industry's expectation. We believe that blockchain technology and the availability of digital financial asset is a huge opportunity for Nigeria. I strongly believe that if we manage this right, if we handle it right, then it will help us solve some of the fundamental economic problems that we have. For instance, the concerns that was being raised about green energy in terms of mining of Bitcoin. Do you know that Nigerians are still flaring up gas worth billions of dollars every single month, you know? And you know, gas flaring is a total waste of opportunity, which as a country, if we can put the regulatory framework that will manage this industry, then a huge revenue can actually come from that wasteful venture that is going on. Of course, you can see that economies in Southern America are leveraging the opportunities that the Chinese crackdown on miners is creating. And we're expecting that our economic policymakers should be proactive. They should be, their eyes should be open to opportunities, global opportunities like this, and they should be able to market these opportunities to business people who are bringing a lot of foreign exchange that they want to set up mining farms across the Niger Delta regions and utilize this wasting gas resources that we have to turn them into economic gold mine for the country. So these are the things that we're expecting. We're looking at government and policymakers that are proactive, they are forward thinking, that have the intention and the right disposition for the betterment and good of the Nigerian people. Thank you for your time today.
Thank you very much, Chimezie. And that brings us to the end of this panel session. I see some questions in the chat room, but we won't be able to take those because of time. But please keep the conversations going on the CMSA platform, as well as LinkedIn with any of the panelists, Zelda, Tosin, Chimezie, or Mr. Ekpeyong. So at this point, I'll just bring the panel to a close. Thank you very much for joining, and please stay tuned for the next panel session. Thank you very much, and have a lovely day.
Thank you.
All right, thank you.
So we're going to be going into the second panel, which will be discussing technology and funding real sectors. I'd like to welcome Mr. Adeleke Alex Adedipe, who will be moderating this session.
Good afternoon, everyone. My name is Adeleke Alex Adedipe. I work at the law firm of Duale, Ovia and Alex Adedipe. I am privileged to have worked on a few landmark transactions in relation to the TMT space in Nigeria. I'm an active player in the ecosystem. And in addition to that, I also advise clients in relation to their day-to-day transactions. It's an honor and privilege for me to be moderating this session this afternoon. I know it's lunchtime, but please bear with us and we'll try as much as possible not to take too long. I have on this panel Like I said, it's an absolute honor for me to be moderating and to have a panel filled with experience, knowledge, and a lot of resources. I will start by introducing each of the panelists, and I'll introduce them in a line and allow them to speak to what they do and a bit more about themselves in about 30 seconds to a minute. I'll start with Oguche Uguda, who is the CEO of Pension Fund Operators Association of Nigeria. Oguche is currently the CEO of the Pension Fund Operators Association of Nigeria. His role, he leads the efforts of a $28 billion in pension industry in Nigeria in engaging regulators, the media, and financial markets, and other stakeholders. Oguche, can you please speak a bit more about yourself in 30 seconds to a minute, please? Thank you very much.
Thank you. Like you said, in my role, I try and lead the efforts of the industry in engaging various stakeholders. So the industry has various needs, and my role is to protect and promote the industry, but also to see how the industry can begin to impact on economic development, financial inclusion, and just general goals for the pension industry. Thank you.
So thank you very much, Oguche. Next in line is Kevin Hills, who's a partner equity capital markets of Weber Wenzel. Kevin is a South African attorney and an English solicitor who specializes in corporate and commercial law. Kevin, please, can you speak more about yourself? Thank you.
Thank you. Yes, so I'm a partner at Weber Wenzel. I focus in cross-border transactions and equity capital markets. I'm hoping to share some insights from down south at the tip of the continent and hopefully learn from my colleagues in Nigeria, already appreciating the energy and innovation I've seen on display today. Thank you.
Thank you very, very much, Kevin. Next is Michael Nzewi, who is the managing director of Cardinal Stone Partners Limited. Michael.
My name is Michael Nzewi. In my day-to-day, I lead the investment banking business at Cardinal Stone, and I also lead the management team. Essentially, we help Nigerian entities as well as multinationals raise capital in the market. We also help companies who are trying to expand either inorganically or organically to raise capital for organic expansion and to do acquisitions for inorganic expansion. So yeah, that's what I do day to day.
Thank you very much, Michael. Thank you very much, Michael. Next is Eric Idiahi. Eric is the co-founder and partner of Verod Capital Management Limited, a private equity firm with over $350 million under its management. Eric.
Thank you very much for the introduction. My name is Eric Idiahi. I'm a co-founder and partner at Verod Capital. Verod Capital, we are mainly involved in private equity, investing across various asset classes in West Africa.
Thank you very much, Eric. Unfortunately, we don't have Tinu Awe with us this afternoon. She just sent a message. She's unavoidably absent, and we'll just go straight into the business of the day. So the elephant in the room today with us is technology and funding real sector in Nigeria. And the conversation that the panelists will be having this afternoon will be centered around what are the options that are available. There's clearly a gap in funding real sector in Nigeria, and what options are available for us to do this? What role is technology playing in enhancing this funding gap, in helping us solve this problem? And what are the regulators doing? What options can we take from the likes of Kevin in South Africa, who can explain to us how this has been done in other jurisdictions? For the likes of Eric, who are in the room, how have they been able to do this? How is the capital raised to be able to bridge this funding gap? It's been happening. We're going to spend the next 40 to 50 minutes doing this with you. And we hope that we'll be able to take some questions thereafter. But we also know that we are actually behind time. So I'm just going to go straight into the questions right away. My first question this afternoon is to Michael. Michael Nzewi. Michael, like I said, and I alluded earlier, there's clearly a funding gap. In what ways do you think that that technology can be deployed in bridging this funding gap in the Nigerian real sector? Michael.
Thank you very much for sending the first question my way. I think clearly there is a huge gap in the market in terms of funding needs, and obviously one of the challenges we continue to have in the market today is how do we attract the right type of capital and at the right cost to be able to bridge this gap, right? So you find out that we at Cardinal Stone are essentially a very traditional investment bank. So asset management, investment banking in the way it's been done traditionally. However, we are seeing the kind of disruptions that technology is bringing into the space. And we are moving very, very quickly to make sure that we adopt a lot of the new disruptions and opportunities we're seeing. I think having said that, how can we use technology to bridge the funding gap in the market? We see that in three buckets. We usually look at that in three buckets. The first bucket is how can we even use technology to improve what we do what we do today in the traditional way that we've been used to, right? So in the existing capital raising process, how can we use technology to improve that, make it a lot more efficient, and use it to attract more capital, and hence you're bridging the gap we have in the market. And we've done that in certain parts of the processes, and I'll give a few examples. When I look at the usual capital raising process we have today, there is a portion of it where you require the registrars at the end of the process to actually collate all the investors in any capital raising process, whether it's equity or debt. And we have found ways to create technology-enabled platforms to actually automate that collation process, which when I came into this market, that part of the process, we used to allocate about 2 weeks, for that collation. Today, it is done within a day or two, the end part of the capital raising process. So that's how we look at it. That's the first bucket, which is using technology to improve the traditional way we do things. I think the second bucket we like to look at is some of the disruptions we've seen in the market today, which I believe should set in by close of business today. I think the SEC has said that by the end of today, the existing platforms have to have been registered with them for crowdfunding. And we've seen crowdfunding actually close a lot of that gap in manners that we haven't seen before. We've seen it help actually leapfrog fundraising opportunities. If you talk about a company like Farm Crowdy, we know they've raised several millions of dollars. So, crowdfunding can actually raise a lot of money. It's one of the benefits of crowdfunding. It can raise a lot of money. It can raise a lot of money in a very quick way as well. So think about the traditional fundraising that we're used to, where the process can take several months. You have to register, you need to have certain track record and all of that. Whereas for crowdfunding platforms today, it's all you need is you set up your business, you register on the platform, and you can get the fundraising process much quicker than what we do traditionally. It also gives you a lot of access to investors that ordinarily you would not have been able to reach in the traditional way. So I think we usually refer to that as democratizing the whole investment process. So today you have retail investors whom ordinarily we would never have approached if who were fundraising in the traditional way we've been used to, they usually get access to very good opportunities, to invest in companies through crowdfunding and platforms. So as we all know, the biggest assets in our capital markets remain the investors. Without them, there is no market, be it retail or institutional investors. They accumulate the investable funds and they provide the funds that are invested in businesses to drive economic growth. So what crowdfunding has helped us achieve is it's created access for investors in a way that we've never seen in the past, right? I think the last bucket that we typically look at is we've seen new technology platforms actually come up to help digitize, let me use that word, digitize the whole fundraising process. And I think one of the companies we kind of trying to use technology to give companies the opportunity to fundraise. Now, we have also started working with a UK partner. Obviously, discussions are still very early. So at this point, I will not be able to mention the name, to create platforms similar to that, where the whole fundraising process end to end is kind of automated using technology, using algorithms and all of that.
Thank you very much, Michael. And clearly, there's been some activity, and based on what you said, your company and other participants in the sector are using technology in one way or the other to bridge this gap. And that will take me straight to crowdfunding. And I completely agree with you. We've seen some of these platforms before now open a product in the morning, and before 12 o'clock in the afternoon, it's completely fully subscribed. And good enough, the SEC took on the initiative and decided that crowdfunding has come to stay, and has decided to regulate the activities of crowdfunding participants in Nigeria. That will take me straight to Kevin. How does crowdfunding operate in your jurisdiction? And is this a regulated activity? Just tell us about how it operates in your own jurisdiction. Thank you very much, Kevin.
Thanks. Well, first, it's not strictly a regulated activity. It finds its expression in donations, crowdfunding sites, and rewards crowdfunding sites. There is arguably an equity securities crowdfunding site. It's just started, but it uses a very unique model. But just to take a few steps back, just to explain, I mean, crowdfunding is not specifically regulated, and the major hurdle to its use in South Africa is in the Companies Act and the regulations around offerings of equity securities to the public. Obviously, if it meets that requirement, it will have to issue a prospectus and have a prospectus registered, which is not really appropriate for small and medium-sized enterprises. There are a few safe harbors in our legislation to allow for very small crowdfunding subscriptions of up to R1 million, less than $100,000 US dollars. So it's not really, it hasn't really taken off in South Africa, and we're desperately in need of some legislative innovation here to try help the passage of it through into the mainstream. We do have, interestingly, some crowdfunding for alternative assets outside of equity securities in businesses and companies. We have a livestock wealth crowdfunding site where, and it's been quite successful, where people invest in cattle, and the cattle is reared by a farmer, and at the end of the whole process, the cow is then sold or bought back from the owner and sold to butcheries or the retail market. and you'll make a profit over that period. There's also crowdfunding platforms for investing in real estate, which has also been quite interesting, based in South Africa, but investing in South Africa, Africa, and elsewhere in the world. But for the most part, the crowdfunding, as I think we all understand it, and I think a lot of the people listening would understand it, investing in businesses and obtaining a security or an equity interest in that business, that unfortunately does not exist on a wide scale in South Africa. And I was hoping today to hear from some of our colleagues if they have any ideas how it could be incorporated into South Africa. I'd be very interested. Thank you.
Thank you very much. And good to know that Nigeria, in this regard, we appear to be a few steps ahead of South Africa. Next will be Eric. Eric, based on your experience, what are the challenges you have come across in investment in real sector, and in what ways do you think technology can help resolve some of these challenges?
So one of the things in general, it's very obvious that the future and business is changing very fast. Tech and just efficiency of doing things, efficiency of staying and being competitive requires companies today to be very tech savvy. You see a lot of startups, fintechs, and other startups in different tech spaces eating the lunch or doing a lot better than their traditional counterparts. So in investing, one of the key things we do is really, we're starting to do sort of a tech DD to understand where the companies stand. We invest in from a tech perspective, because of course we don't feel we can get returns going into the future if those companies are not tech savvy. So for us, it's looking at from top to bottom, the systems and how they actually interact with customers, or how they interact in a B2B perspective or platform based on what systems they currently have. So that's becoming increasingly crucial for us in making investments into companies. Because without that, we feel that we can't really achieve great returns from companies today.
Thank you very much, Eric. And I think I'll ask you another question right away. Do you consider that there are any relevancies of technology in your own funding activity as a VC? What do you think? Are you using technology, and is there a relevance of technology in your funding activity? And you can share some experiences in this regard. Thank you.
So I'll answer that question in two different layers. From our side, of course, even as a traditional investment firm, we've gone now in terms of even assessing how we invest, what we invest in. We've created certain algorithms to understand how to invest or what to invest in. I even have a system where we're currently building that scouts on LinkedIn to understand certain, I can't of course disclose all of that here, that understands certain key attributes to companies or businesses and people on based on their LinkedIn profiles or activities on LinkedIn. So we're increasingly using tech to understand how to view companies, how to value companies, and what kind of companies to go towards and invest in. So that's one aspect of it. On the other hand, in terms of companies we invest in, is really trying to bring them into the fold of technology and digitizing the businesses we currently invested in, the traditional business we're invested in. So from a private equity standpoint, we've invested in a number of traditional businesses. And the first thing we do now is really taking those businesses to as much digital as possible, not just IT or giving computers or everything else like that, but it's just even the processes in which today those businesses operate, which we're really making a strong efforts to make them more digital than anything else.
All right, thank you very much, Eric. I'll move straight to Oguche. Oguche, your question basically centers around pension fund administrators and how pension fund administrators have been able to use technology-enabled investments such as crowdfunding. Or how would you, sorry, let's put it this way. How would you describe the appetite of pension fund administrators towards technology-enabled investments? An example being crowdfunding.
Yeah, thanks, Adeleke. I think the first thing I'd like to say is, oftentimes people use a brush to paint the pension industry, and they don't realize that there are 22 pension fund administrators and 6 closed pension fund administrators. So in essence, you have 28 organizations who perhaps have different investment strategies, who perhaps have different views about the market, or perhaps have different ways they like to do things. So in that regard, the appetite might vary from firm to firm. Having said that, I'll also just say that the pension industry is very regulated, and what we do has to line up, number one, with the Act, and number two, with the investment regulation from PENCOM. So we can't invest directly in companies. The industry can't invest directly in companies except either through a bond, an IPO, and a listed exchange, or through a fund. So I believe some of our pension funds are invested in a fund of one of the firms on this panel. So it's really indirect investment to be able to pick the fund managers who are doing what Eric had just said, ensuring that the companies they invest in are technology-enabled, digitizing their traditional companies. And so I think it's from that angle that we like to look at the technology-enabled investments, i.e. investing indirectly through funds for now, and the discussions about investing through exchanges, but that's the way we like to see it at this point. Thank you.
Thank you very much. Thank you very much, Oguche. I'll come back to you, Kevin. Based on your transactional experiences over the last few years in South Africa, what interesting fintech products have you seen in the market apart from crowdfunding? And you said crowdfunding isn't really regulated in South Africa. So what products have you seen in the market in South Africa that has enabled real sector funding?
Well, just to clarify, we do have crowdfunding, but doesn't allow an investor to take an equity stake in the business. You can donate, and I'm sure you probably have similar websites there in Nigeria. You can donate, or you can sign up and contribute money in return for rewards. But other than that, it's not regulated. We have seen a few other developments here in South Africa. I mean, with the penetration of mobile networks and cell phones, we've seen a lot of movement in things like the payment systems industry. In particular, I think we closed a deal in mid to end last year for MasterCard, where they sold a QR quick response payment service. The technology had been developed in South Africa. It was bought from a local bank in South Africa and then bought by MasterCard, which used it for its MasterPass payment system, which is essentially an online wallet that uses QR payment services or technology. And that was sold to a new company that's, I think, looking to expand the use of QR payment technology in South Africa. I mean, if you look at it, you've got in China, as I understand, majority of transactions are now done through a QR payment device or reading, and that and that happened over a short space of time. And I think as we manage to get that penetration of mobile connectivity and the uptake of smartphones, we are expecting that there's going to be a growth in these type of payment systems. It's interesting in South Africa, we don't allow unregistered banks or unregistered companies to facilitate to use the e-money that's used in these payment systems. So any of these intermediaries would have to pair up with a local registered bank, and essentially would provide the technology and the intermediary services between the bank and the end customer. So ultimately, you do need the historical sort of brick and mortar financial institutions and banks to provide the backstop for those transactions. We've also seen, I'll just raise it, I don't know if the other viewers have been following developments in the States with the likes of Robinhood, which is like, it's an app, it's a stockbroking app. We've seen a similar process in South Africa with a company called Easy Equities, and it's partnered up now with one of the major banks, and that essentially allows retail investors to participate now in IPOs and to invest in a whole range of local companies and ETFs. And that, it's interesting, what they're doing is they don't have a platform fee, or they've reduced the platform fee to encourage retail investors to invest. And each investment that's made, or purchase or sale, is made at a very small commission. And so I think that's also encouraging market participation. We currently have 3 stock exchanges in South Africa, which, I mean, we have the Johannesburg Stock Exchange, which is the major stock exchange, and then 2 other new stock exchanges. And it's really opened up a whole plethora of investment options for the man in the street. So I'm hoping that would also encourage, you know, the movement of capital, retail investing, and hopefully medium-sized businesses who are willing to list on one of the exchanges, maybe one of the exchanges with lesser sort of requirements around publicity and ongoing requirements. And that might help to plug the gap until such time as we regulate and sort out the crowdfunding question with legislation. Thank you.
Thank you very much, Kevin. I'll go back to Michael. I'll go back to Michael, and my question now is: to what extent do you consider that regulatory oversight can serve to stifle the pace at which technology-focused products can be utilized? Again, there's been that major question about regulators stifling the growth of tech experts and participants in Nigeria. In what ways do you think that this regulatory oversight does stifle, and what can be done about this? This is Michael. Michael.
Sorry about that. I said, thank you very much. And that's a very good question. What you find out is that globally, one of the biggest challenges to tech, and this is not just in Nigeria, has been government bureaucracies, right? And I think most countries that have recorded tremendous growth did so when government agencies reduced bureaucracies and eliminated some of the draconian rules. I think, luckily, the SEC in Nigeria has set the ball rolling, especially for the MSMEs, right? Today, the SEC has said that the MSMEs can raise anywhere between 50 and 100 million from crowdfunding portals. Many of these companies are companies that will never have been able to access the investors that will come to those portals to invest in them. So I think that if the regulator can continue to be progressive in the way we have seen the SEC react to the developments in the tech funding space and crowdfunding and all of that, I don't see the sector being stifled. I think what we need to do is the regulators just need to continue to remain progressive, right? Because, as we all know, tech innovation, these innovations come at lightning speed, right? So the regulator must reduce the play of catch up and perhaps even get ahead of the operators. In the last panel, I think someone had mentioned about ICO, for example, and why is that not being deployed in Nigeria. As far back as perhaps 2017 or 2018, a Nigerian remittance company called Shore Remit had issued initial coin offerings, and they raised about, I believe, $7 million in that. Again, capital that wasn't here before, but it came through, and it was foreign capital coming into the country. So this is one area that perhaps the regulators should also look at and see how we can provide regulations, obviously, to improve the opportunities around that, while making sure that investors are not exposing themselves to too much risk. Because what you find out again is that in a lot of these crowdfunding portals, one of the biggest challenges you have is that there are quite a lot of fraudulent ventures out there. But I believe that with the way the regulator is going about it, the regulations are out, the operators will have to scrutinize the investment opportunities being brought to their platform. That, in my opinion, should sieve out a lot of the potentially bad investments, especially when you apply the process and the requirements which the regulators, which the SEC has put out, which in my opinion, I think is quite robust. And ultimately what we get is very high quality investments coming through for the investors on the platform, and a much improved success rate for some of the young companies that are coming to those platforms to raise funding. Thank you.
Thank you very much, Michael. Thank you very much, Michael. And I join you to also appreciate the SEC in the work they've been doing in encouraging startups. And also, I guess we can all say that the SEC has not stifled innovation. The SEC has been supportive, and of course we can do more with a lot more support, but the SEC has been doing well. Still talking about regulation, and this is to Eric. Do you think that the present regulatory framework for tech-focused funding platforms provides sufficient protection for investors?
So first, let me commend, I think, the regulators, the SEC, et cetera, for the great job they've been doing in getting to the 21st or the 22nd century, I like to call it, and getting up to date with tech. I think they've done a wonderful job compared to other regulators across Africa. So first, nothing is perfect. I think that this is, I'll say, version 1 of it. And so far from what we have, of course, with the banks, we have the NDIC, who provides some regulation. And even with that, the regulations the NDIC provides, it's not for every amount of cash you have in the bank or every investment you make in that sense. So I think what they have for today, for the first stab, or for what we currently have in place as a structure and as I guess in Nigeria, as the environment broadens, I think it's okay. I personally think it's sufficient for now, but I think over time, as everybody gets to understand this platform a lot more, it evolves. And yes, there's a lot of currently just understanding the market. There's a lot of room for fraud. There's been a lot of issues, but I know some of the regulations they have, like being able to reverse investments within 48 hours, DD on those investments. Those are covering some of that. And I think as time goes on, those will be refined to get better.
Thank you very much, Eric. Oguche, what do you consider to be the key risk factors that need to be addressed to encourage PFA participation in these new tech-enabled products? And what can be done to improve the appetite of PFAs in this regard?
Yeah, I think the first thing is probably more engagement. There needs to be more engagement between potential issuers, advisors, capital market operators, and the pension funds. Because oftentimes what we see is either some products or some firms are coming to the market or looking to raise money without maybe prior engagement. And then when it gets to the pension funds, they are not willing to invest. So I guess the first thing, is engagement, more engagement rather than less, to co-create. We were in an era of co-creating products, co-creating structures, together with the market, together with the advisors, potential issuers, and even regulators. So forums like this also helped just to co-create. Again, is being able to get more companies to the point whereby they're able to list on exchanges. And with that comes more transparency, comes a bit more governance. So the PFAs obviously want to see more governance in some of these companies. And we do understand that maybe some of them might not be able to. And with any investment you make, by the time it's public, as you always say, then the cream has left. Some people in private markets have probably taken the cream and just bringing it to public. And of course, pension funds would like to get a pie of that. But like I said earlier, we can't do that directly. So it's working with fund managers to be able to set up funds that invest in those companies, and pension funds can invest indirectly. So I guess there always has to be an intermediary within the pension funds and those companies as at now, except they get to the level whereby they're able to come directly. And there are some innovative structures that some people are beginning to use, which we're also engaging in terms of things like a bulk bond issue, i.e. one company comes to do an issue and then begins to invest in all of these companies. Fund of funds structures are also things that could also work. So I guess it is essentially ensuring that some of these tech-enabled companies are able to transition to the financial markets where the pension funds play. That gives a bit more confidence, liquidity, and then it helps us stay in line with the regulators. Thank you.
Thank you very much. Just one follow-on question, Oguche. Do you think that there should be more room for PFAs to play in markets like this? Should the laws be amended to give more opportunity for you to be able to make more investments, of course, indirect investments in markets like this?
Yes. So again, it's neither here nor there, and I'll go back. Forgive me, I might be a bit diplomatic. I'll go back to the fact that there are 28 pension fund administrators, and 28 of them can decide how they decide their strategy. But I'll just say that even world over, pension funds, if you look at the level of their VC investment, is really between 5 to 7% of their assets under management. And if we're able to get that in Nigeria, that'll be a great. So we don't want to invest as much in these sectors because yes, technology is risky, that there's a potential for high returns, there's also potential for loss. And because of the fiduciary responsibility that we bear in terms of ensuring that people like you will be able to retire well with their pensions, we don't want to go the whole hog there. But yes, 5% or so, but the regulations currently in a sense, are flexible enough. I think they are flexible enough to allow the pension funds to invest in that area. I think the issue more is the deal pipeline and then the products that are coming through and the engagement. That's my sense, though. I don't know if other panelists agree or not.
Eric, what do you think, please?
Sorry, I was on mute. Yeah, no, I agree 100%. I think to everything you said on that, there's a clear balance, of course. Also, from our perspective, we actually own a PFA, pension fund administrator. And for me, even though I have been, and I think a firm also have been very big investors in tech, but of course, there's a balance in which you need to actually have in that sense to protect for long-term protection of actually assets on ground. And but as you expand to various asset classes, you would see that mostly a lot of the investments going into this sector have been outside, investors from outside Nigeria and outside Africa, and very little from inside Africa. But as we understand the market slightly more, the market that gets developed, some of these things will change. But also has to be a bit of a limit in which a balance in that sense from a risk perspective, because I know we've seen great investments, high numbers being called, but at the end of the day, you're probably for every one winner, you're probably going to see 20 losers at the end of the day. And as time goes on, you're going to probably see a lot more failures in this space. There's a lot more announcements of big failures in the space and a few winners. So it's very good to be cautious. I know it's very exciting times now in general with tech, with crowdfunding, with everything. I mean, now it's even my driver is asking me how I can invest in tech. So it's so yeah, we just all have to be cautious at the end of the day still.
All right, thank you very much, Eric. One question for Michael, and that's a follow-on from Eric's conversation. It's in relation to local investment. Generally, it would appear that we don't have enough local investment, not because the resources are not available, but maybe out of fear or the appetite is in there. Then there are a lot more foreign investment than local investment. How do you think we can bridge this gap? Or what do you think is responsible for this? Michael.
Yeah. Thank you very much. That's another very good question. But Eric, who owns a pension fund administrator, has spoken. I will just reinforce what he's saying. I think obviously the market is still evolving, right? You know, we are actually on the other side, and we think that the institutional investors today, that market is largely controlled by the pension fund administrators. We think that they need to, you know, push out a bit more, take a bit more risk. But at the same time, we tend to understand where they are coming from. It's still a very, very young industry in the country, still less than 20 years old, right? So I think at this point, protection is so much more important than even the returns and risks. But I believe that will evolve over time. Now, to your question, which is how then do we bridge that gap, right? You find out that there are still pockets of investable funds that obviously, if we're able to explain the opportunities and the risks associated with those opportunities better, that those investors will take those risks. If you look at the market today, many people are very, very averse to investing in equities, for example, and it's still down to, you know, what we're talking about, risk, right? But in my own experience with at least a lot of our clients, what we've realized that it's all about communicating these opportunities properly. And that we you know, a lot of our investment advisors in the firm understand that you must create the right. And yeah, so one of the ways I believe that this bridge or the gap can be bridged is through a lot of investor education, through bringing opportunities that have been well put together, right? The risk has been properly addressed and managed, of course. And you know, you see the investments will follow through. As for our institutional investors and the PFAs, I believe they will evolve. It's a matter of time, right? Today we are seeing more infrastructure funds come to the market. If you go back 5-6 years ago, we didn't have any of that. And you know, that's the natural evolution we will go through. With time, the PFAs will want more return, so they will start allocating a bit more money to a bit more risky investments, and that will continue to help bridge the gap. We just need to kind of find ways to catalyze that movement or that process from where we are to where we need to be. Thank you.
Thank you very much, Michael. My next question is to Kevin. And again, it flows from Michael's conversation. And this time around, we just wanted to share your experience from another client and your jurisdiction. How does this work in your jurisdiction? Do you experience the same things that we've spoken about, that Eric has mentioned, that Michael has alluded to? in terms of local investment versus foreign investment, particularly in this sector. How has it played out? Local funds in your jurisdiction, are they deploying a lot more resources there, or are you experiencing things like this? What's the appetite like over there? Thank you, Kevin.
Local fund managers are deploying a lot of investments here. I think there has been a move, I mean, given the international growth and the disparity against local growth, in particular during the COVID lockdowns, there has been a sort of a move abroad for yield. Foreign investment into South Africa is also seems to be cyclical. We've obviously have a lot of mining operations, and we depend a lot on mining for our exports. So we've seen a lot of inflow into those sectors from international investors and local investors. I think for the most part, we're just trying to see the lie of the land to see, whether there would be any, change in the COVID numbers, for example. The infrastructures here in South Africa, we have sophisticated legislation and financial institutions for the money to flow. So we are hoping, we are expecting it to recommence, and we've seen, green shoots. Unfortunately, we've gone into our third serious lockdown at the moment. So who knows what will happen in the next few months. But overall, I think quite positive, and also taking direction from the international sort of, economy that seems to be moving forward with low interest rates and lots of opportunities to invest post lockdown.
Thank you very much, Kevin. To those watching us and listening to us, remember we promised this was going to be between 40 and 50 minutes. We have just 2 questions. I'll take 2 questions now, and I would allow the panelists to give 30 seconds to 45 seconds of a closing remark. My first question, and this goes to either Michael, Eric, or Oguche, can take this. This person says, with the rise of internet comes the nervousness of the government. There has been a battle to censor and spy on citizens, hence the acrimony between corporations, citizens, and authorities. The NSAS saga complicated everything. How do entrepreneurs like myself combat this issue? Who would like to take this? Michael, Eric?
Michael, I nominate you to take it.
I second that.
That's fine. That's fine. So obviously, whether it's from the government or not, entrepreneurship itself, it's a very, very difficult journey. So many challenges that entrepreneurs will face in the course of trying to build a business. Whether it's government, you engage, you must find ways to you have to comply with the laws of the land. You have to be a very responsible entrepreneur if you want to build your business. And if government is getting in the way, then you engage. And with the right level of engagement, what we've also seen from our own experience is that you usually end up having your way actually. So government actually listens, but because of the pressure of entrepreneurship, the natural default is for one to get frustrated and perhaps throw some tantrums. But I think the government understands we are all trying to create jobs, we're all trying to grow the economy, we're all trying to create wealth. So with engagement, you always surmount many of these challenges. It may take time, but I think the end usually justifies the means.
Thank you very much, Michael. Thank you very much, Michael. And I completely agree with you. I know I asked you the question, even though it was a question that was asked by someone, but I completely agree with you. I think that with a lot more engagement, we can always get to that finish line that we all seek to achieve. We can, it may seem tough, but again, that's how we can get results. We also have to act right within the ambits of extant laws. I have the second question, and I think Eric would help us with this. It says, I have a major concern about crowdfunding. Investors should appreciate that this is still a business, and as such, profits are not guaranteed. I have observed that when returns on investment are not forthcoming or as expected, investors usually instigate criminal proceedings against the fund managers. I suppose we could technically call them hedge fund managers. What can be done to significantly reduce such unpleasant incidents?
So I guess there are two levels of it. From my part, of course, so I'll talk about crowdfunding in a second. But for my part, in terms of investing private equity, VC funds, of course, every investor we bring is an institutional investor who's accredited and knows the risk that faced with investing, that you can lose your money, etc. So those investors, I guess, understand some of those risks. As long as you don't do anything illegal, then of course, investing is a risk. You can lose money, you can make money. Now going to the crowdfunding part of the equation, of course, there are more retail investors there, and some of these people might be not really fully understand that risk associated with it. I mean, betting a huge part of their savings or a huge part of their income. But occasionally, I'll say you can take it to court if you've done absolutely nothing wrong. Then there's no standing. With business, of course, I do a lot of things. We get lawsuits all the time flying around from people, come up with all kinds of things, but are not really accurate or not correct. So as long as you know you're doing a business or you're doing something, you're doing everything correct and you're doing everything accurately, without anything illegal or without any side courts or without short courts or without anything that anybody can actually hold up against you in court. It's just part of doing business. You're going to see people disgruntled and unhappy with several things. So I don't think it's as long as you're doing everything correctly, I don't think it's a problem to worry about, because it's part of doing business. I think every businessman or every business in Nigeria that's doing well or doing bad has been sued or will be sued. So that's why Lekki is making so much money as a lawyer, and that's why most people, lawyers on this group are here today. That's why they exist.
Thank you very much, Eric. I'm not sure about the last part of making so much money, but again, it's the reality. I guess the bigger your business becomes, the more susceptible you are to things like lawsuits and all of it, and even some people just trying to take a dig at you. Thank you very much. I've taken all of the questions from the guest, and I've taken my own questions. I'll just give the panelists just one last short on parting words to us. I'll start with Oguche, 30 seconds to 45 seconds.
Thank you, Adeleke. I think it's an emerging sector, and the pension funds definitely are looking to get involved. But again, like I say, more engagement, more understanding, and it's a case of when, not how. We will get involved, but little steps. Thanks.
Thank you very much, Oguche. Kevin?
Yes, it's interesting to hear, and from this discussion, what's happening in Nigeria. I think there's a few takeaways. There's also, I think, some shared examples. I'm sure there's things that we're doing here in South Africa with fintech that could lend itself to its use in Nigeria and probably needs to be explored.
Thank you very much, Kevin. Michael? Michael? Michael?
Michael, you're mute.
I think in closing, I would like to just focus more on the area we touched on about PFAs, because this is one area that directly impacts our business, given that we have two key operators in that space on the panel, Oguche and Eric. Obviously, when we look at the the data in Nigeria, the PFAs typically just don't want to take, they try to keep away from risky investments. I had said earlier that that's going to evolve, and it will surely evolve with time. I think for context, if you look at the portfolio of our total pension industry today, about 88% of that is actually in fixed income instruments and mutual funds, and just about less than 8% is in equity investments. And this really highlights the low appetite for the PFAs to invest in risky assets and ventures when compared to some other PFAs in some other jurisdictions. Like in Poland is as high as 82% in risky investments, and in France, Norway, US, and Switzerland is not of 30%, between 30 and 40%. At the end of the day, right, you find out that a lot of the gap is being bridged by investments coming from even these PFAs through, obviously, fund managers from outside the country or from foreign jurisdictions. We know it will take us time, but we have to keep urging you to try and help catalyze the process of this evolution to the point where we see more pension funds allocate a bit more to risky investments, because ultimately that's how platforms like even the digital platforms and the crowdfunding platforms we're talking about, that's ultimately where the funding will come from, because that is the biggest source of capital in the economy. Thank you.
Thank you very much. And last but not the least, Eric.
So I'd like to say, yes, we've been very, I've been cautious in terms of, I've spoken very cautiously about the risk of investing in tech, but I'm a very strong believer in the sector. I think businesses, as you know it today, are dead. Traditional businesses are on the way out. I think in the next 5 to 10 years, the biggest companies in Nigeria are not going to be the businesses you see today on the stock exchange or the businesses we know about. They're going to be tech businesses. The biggest banks in the country are not going to be the banks you know of today, but they're going to be fintech businesses that are starting now or have started a few years ago. So this sector is one to stay and one that would actually dominate the future. So it's very important to really be a part of that sector and know how to play in that sector, but also be very calculated in the business you invest in and making sure you're investing in the right type of businesses and the right type of tech businesses, because this is the future.
Thank you very much, Eric. And I think the good part is, and part of what the CMSA is doing is to try to bring to fore these activities and try to engage with regulators and ensure that people like Eric, people like Oguche and Michael can find where to put their money and also grow this sector effectively. I think everyone would agree with me that this set of panelists have done absolute justice to this topic. And if you choose to follow on with them, I'm sure you can send them messages or send them emails or go through the CMSA for follow-on questions. Thank you very much, Kevin. Thank you, Eric. Thank you, Oguche. Thank you, Michael. And thanks very much to CMSA for this opportunity. Thank you very much.
Thank you very much, Mr. Alex Adedikwe, and all the panelists for that very engaging session. I'd like to welcome the chairman of this year's CMSA Annual Business Luncheon, Mr. Ayodeji Oyetunde, to give the closing remarks and vote of thanks.
Thank you very much. I think it's been a very engaging session. Thank you, Leke, for the way you rounded off. It's been part of an ongoing discussion, and I think that the fact that we had regulators participate at the event and also market practitioners, we were able to throw some light on quite a few issues. And I think all of us collectively, we need to continue to engage as a nation. We need to engage our regulators. One of the questions that came up was a follow-up to the restrictions on internet as a follow-up to NSAS, and you could sort of see the reaction to it. So I think it's for all of us collectively to engage our regulators, and as we continue to engage our regulators, we would ultimately get to where we'd like to get to. And we also thank our regulators because we've seen them also be extremely proactive. We've seen with the recent licensing of Shaka, for instance, that has happened. So we know that they're definitely listening to what we're saying with respect to that. I'd like to thank each of our speakers, Mr. Dayo Bison, Mr. Aigboje Aige Mokwede. I would also like to thank each of our moderators and panelists for their time. We thank them very, very much. Would like to thank each of the participants that took place at the event. Would also like to thank and acknowledge especially our trustees, Senator Odunjiri. Would like to acknowledge him. Thank you very much for your support, sir. Chief Anthony Idigbe, thank you very much for your support. Mr. Uche Valobi, thank you very much for your support, sir. In addition to that, would like to thank the law firm of Detail. Thank you for making your law offices available to us as a physical venue for this event. And most especially, would like to thank our sponsors. There was a lot of participation from law firms generally. Would like to thank the law firm of Banwu and Ighodalo, an headline sponsor. Would like to thank the law firm of Templars, another headline sponsor. Would like to thank the law firm of Duale, Ovie, and Alex Adedikwe, another one of our headline sponsors. In addition to that, we had quite a few platinum sponsors. The law firm of The New Practice, thank you as always for your support at this event. The law firm of Alukwane Ubodi, as always, we thank you for your support at this event as well. Detail, we thank you once again, not only for making your office available, but also for sponsoring the event. The law firm of G. Elias and Co., we reached out to you and immediately we reached out to you. You supported us. The law firm of Simmons Cooper Partners, thank you for your support. The law firm of Udo Odoma and Belo Osage, we thank you for your support as well. Another one of our platinum sponsors. In addition to that, we'd like to thank the law firm of Abdullah Ibrahim and Company. Thank you, sirs, for your support. The law firm of Advocate, you came through for us. We thank you for your support. Alliance Law Firm, very, very early, one of our very first sponsors. Thank you very much for your support. George Itome and Partners, we thank you for your support as well, sirs. Great Chapel Legal, we thank you for reaching out to us and for your support as well. CLP Legal, we thank you for your support as well. Emon Baristas and Solicitors, thank you, sirs, for your support. My honorable chairman, the law firm of Odunjiri and Adefolu, thank you for your support and your continuous involvement. The law firm of Pentagon Partners, legal practitioners, excellent law firm, excellent colleagues, thank you for your support. The law firm of Stream Sowers and Con, we thank you for your support as well. Africa Law Practice, ALP, we thank you for your support, as always, with respect to this event as well. Principles Law Partnership, we thank you for your support as well. Law firm of Alex, we thank you for your support as well. Just final comments for me. Thank you everybody for participating in this event. We thank you for each one of our participants. The event was also hosted on YouTube, so if you want to refresh your memory, the link is available. Just search for it and you can look at it on YouTube. And over the next couple of weeks, we will also try and just take short clips of the session and also post it on the CMSA platforms. And stay safe, everyone, and collectively would move the discussion forward and collectively engage our regulators. Thank you very much.